idea of what do you do with equity when you get the equity news out there. And we're going to begin to see guidance from corporations. And then indeed, we're going to see Q1 earnings announcements as well.
Yeah.
And that's going to be a changed landscape.
Hey, Tom, you've nailed it this week. And I think you've raised the most important issue. You've done better than okay.
I did great on the tots.
Not just on the football. When it comes to the data, when we actually see what we all expect, how will we react to it? How will market participants respond to it when we actually start to see that data and the base effects kick in the coming months?
We're going to stop the show right now and do this, folks, because our next guest is a fancy guy with a CFA and all that. John, we've been talking all week about ex ante and ex post, which is a bunch of Latin mumbo jumbo for having the courage to get out front before the fact versus the reality of acting after the fact. And I'm sorry, what was reaffirmed this week was ex post. People wait to see, including Jerome Powell, what the data is. Wait, and then act.
An outcome-based Chairman Powell. We'll talk about that in just a moment. Let's set the scene this Friday morning. Good morning to you all. We look like this in the equity market. S&P 500 futures up 13 on the S&P. We advance 1/3 of 1%. Tom and I talking about that stability this morning in the bond market. 169.44 on 10s. Had a little look north of 175 in yesterday's session. We come in a little more than a basis point. In the FX market, euro weaker, dollar stronger, 118.95. But more broadly into EM, lira stronger, peso stronger, ruble stronger, rand stronger, and central bank after central bank this week on the EM side, Tom, either hiking rates, Brazil, Turkey, or talking about it, Russia.
I'm going to bring it back domestic, John, with the better news. We had negative rates there in that very short-term liquidity market. We've gone back to a positive 4-week T-bill in the 1-month generic piece as well. And I'd also note, John, as you get ready for the real yield, John, is this going to be an extended version on this Friday?
If we break 2%, I'll give you an hour.
Okay, it could be an hour.
169.44, you get 25.
I mean, I know your people are in discussions, lawyer to lawyer. Negative 0.61 on the real yield, folks. That's from a horrific negative number where we're grinding our way. John, is there any publication that will get the real yield out to zero and maybe to a positive number?
A move towards zero is part of the conversation.
Yeah, okay.
It's part of the conversation. Let's bring in Steve Cheveron to kick things off this morning. Federated Hermes portfolio manager. Steve, I quoted Bank of America earlier this morning. Let me do it again. Interestingly, we have gone from that skepticism about no V-shaped recovery straight to the opposite end, inflation, all within a few months. Worriers are going to worry. Is there any reason to worry, Steve?
I think those fears are a little bit overdone. And I think the bearish argument around runaway inflation it is not going to come to fruition, and they're kind of fattening themselves up for the slaughter here.
So let's get to the money question, Steve. Do you keep your money in cyclicals? Do you stick with it?
Absolutely. No, absolutely. I think, look, you're going to get to a point where, you were just talking about earnings, but forget about first quarter earnings. Think towards second quarter earnings, which is really kind of the 1 year past the trough of the recession. And cyclical sectors are going to have 200 to 300% earnings growth on a year-over-year basis. We've never seen those kinds of numbers. And when you look at the strength of the value run versus growth, it has been every bit as strong so far since Labor Day as the growth run was versus value in the 12 months going up to last August. And I think it still has room to go.
I mean, Steve, you're so handsome there on the Patagonia look today. I mean, you're killing it on a Friday. I'm going to steal a slogan from Patagonia, built to perform, built to last. You are great at asset allocation. For our listeners and viewers, what is a portfolio right now that's built to last?
Yeah, look, I think you want to certainly be overweight equities, which is, the way we've positioned. Wherever your neutral point is, we think we want to be, roughly 60 or 70% of your maximum overweight range.
What does the Gloom Crew have wrong? What does the Gloom Crew get wrong on this Friday?
Yeah, I think it's about inflation. You're going to see temporary price spikes, Tom, right? There's going to be scenarios where we all want to go to the same vacation spot, or we're all going to want to do things that require a lot of oil, and it's going to take a while for supply to come back on. And you'll see some price spikes. But I think the idea that you have a persistent, sustained, long-term upward pressure on prices, it just doesn't play out for us, because on the supply side, there's no reason to think that this economy is any less able to produce goods than it was before the pandemic. In fact, with technological investments, we think it's more efficient. On the demand side, we still have aging demographics around the world. You still have Europe and Japan and China with population decline. You still have excess unemployment, and you still have technology that's representing an unrelenting downward pressure on price. So I just don't see how you get runaway long-term inflation.
John, is he channeling David Rosenberg or what?
A little bit.
I'm sorry. We're
bit.
getting that view versus the gloom on inflation.
On board with the Fed, Steve. Now, here's the big question, I think, going through the next couple of months. Base effects kick in. We see the data. Tom and I talked about it at the top of the hour. How do investors respond? If we get that inflation-induced volatility that opens up some opportunities for you, have you got a game plan for how you approach this in the next couple of months?
Yeah, I think first off, from the Fed's perspective, I think they're trying to slow walk this. They've tried to jawbone it. We'll see how that works. Other central banks, like the ECB, which are doing a little bit of a twist. The hope is that makes the Treasury so attractive relative to foreign bonds that puts a cap on yields. They'll do twist if they need to. They just are trying not to get there. In terms of how you position from a portfolio, look, the cyclical trade is a good inflation trade, right? You have financials, which are going to benefit from higher rates. You have energy and materials, which benefit from higher prices in general. The reopening plays, which are going to benefit from more activity, which is the driver of this inflation. So we think overweight equities there. We think you've got to be shorter on the duration side on your bond portfolio. You want to be overweight spread sectors. We think that's the play, but it's also the play if you get economic growth without runaway inflation. So either way, we think that's the right way to be positioned.
Steve, 8% down, NASDAQ 100, the big cap tax, everybody's making a big media play about it right now. Is that an opportunity or do you wait?
We would wait. So we had been a long-standing overweight on tech and growth. We went neutral back last August and underweight within the fund, my fund. And we think that plays out for a while longer. The incremental news flow is not benefiting them. I can't consume as much more of their goods this year relative to last year as I can on some of these cyclical things, right? There's only so much tech that I can consume, whereas there's a lot of things I didn't consume last year, like travel, entertainment, and I'm going to switch my spending there, and I think a lot of folks will too.
I'm trying to channel Steve Auth in a Patagonia vest, and I can't get there. Maybe we'll see that someday.
We're going to try to get him one. I know he's looking for one of these. So.
Steve, let's channel Steve Auth right now, the wonderful Steve Auth.
Sure.
And I want to talk about use of cash. It is an age of over demand. We're going to get boom revenue, boom margins, boom this, boom that. What are they going to do with all that money?
So I think you're going to see a lot of things. Number one, you've got this elevated savings, which is going to fund, I think, a lot of spending, particularly in the back half of the year. I think when you think about cash as an asset class, if that's what you're getting at, it's easy to hate it and it's easy to trash it, but I don't think that's right. If you think that rates are going to move higher, and I think there's every reason to think, at least in the short run, that they are going to drift higher. Cash is a low duration asset, right? It's the lowest duration asset in a way. So I think cash still has a place in the portfolio, and it gives you the opportunity to use pullbacks in the market to add to those equity overweights, particularly on parts of the market that you think are best positioned. So, yeah, it's going to fund some shopping on the consumer side, and I think from an investment perspective, it's a place to park when you don't want to go into fixed income in the longer end of the curve, and certainly to buy some dips, if those emerge.
Steve, with some Ray Dalio pushback there. Steve, great to catch up. Steve Chevron there, Federated Hermes Portfolio Manager. Tom.
Yeah, I just think it's great. And I really, Steve, thanks so much. And I just really want to say, John, we get a lot of people that talk about asset allocation.
We do, yeah.
Steve studies it. He knows the theory, and he knows it's so much about not what you do, but what you don't do is a huge part of trying to get to a better outcome.
Steve's fantastic. Love the Midtown uniform, making a comeback. And in the commercial break, you heard what he said, Tom. He said nature is healing. When we start to see the Midtown uniform, the Patagonia vest, the sponsored
I don't
vest,
have one. Do I need to go out and get one to be part of the team?
I don't think you want to
with
be
a bow
part of that
tie.
crew.
It'll look,
A bow tie and a Patagonia vest with surveillance on the side, walking around Midtown. When you start to see more of that in Manhattan, Tom, we're getting back to business, back to normal.
I was walking around this week, John, and for all of you across this nation and worldwide, here's a report. Chairman Powell was right in his press conference. We're not there yet, John.
We're not there yet.
We got a ways to go.
But if you notice the one thing that comes up, the key variable in all the conversations we're having, where do the savings go? Where do the stimulus checks go? What does the savings rate look like?
Demand.
We heard that from Hugo Rogers in the last hour. We've heard that from Steve Chevron this morning. And you know where we got pushback? We got pushback yesterday from Adam Posen of the Peterson Institute, Tom, who doesn't think that story develops in the way some people think it will. And therefore, his view on inflation is a lot less worrisome than what we're hearing from others.
And also, I got the tone from Dr. Posen that the GDP number of the Fed is very responsible. I didn't hear him going out to the Ellen Zentner number or the John Herman at MUFJ 10% number.
Or the Jan Hatzius number for that matter as well.
Yes.
Here's the scene this morning, this Friday morning. Good morning to you all. We look like this on the equity market. S&P 500 futures advancing 11, 12 points on the S&P, up about a third of 1%. Some stability in the bond market. I am clueless as to how long that lasts, but there it is right here, right now. 169.62, Tom, in a basis point. And Japan just saying zero's the target, 25 basis points either side is the band. Zero for a long time. Ruble stronger, EM better in the last couple of days. A hike from Brazil, a hike from Turkey, and Russia saying, you know what, we might join the party in the next couple of days. More still to come on this program. In the next hour, 8 a.m. Eastern Time, Brian Levitt, Invesco Global Market Strategist from New York, alongside Tom Keane. I'm Jonathan Ferro. Lisa back with us on Monday. Heard on Bloomberg Radio, seen on Bloomberg TV. This is Bloomberg Surveillance.
With the First Word News, I'm Ritika Gupta. The first top-level talks between the Biden administration and China were bound to be confrontational. Now the question is, can the two sides find a way to cooperate? In Anchorage, Alaska, diplomats from the world's largest economies criticized each other over everything from human rights to trade. Secretary of State Antony Blinken accused China of undermining global stability. The Biden administration is considering whether to impose more sanctions to block construction of that gas pipeline from Russia to Germany. The Nord Stream 2 pipeline is almost complete. Bloomberg's learned the U.S. may sanction the project's parent company. Penalties on other companies are also a possibility. The European Union has a chance to put coronavirus vaccinations back on track today. Regulators have given AstraZeneca's vaccine the all-clear. EU governments, including Germany, France, and Italy, say they'll immediately resume administering the shot. Several countries suspended its use after reports of blood clots in some patients. And oil is heading for its biggest weekly loss since back in October. A sell-off has been driven by concerns that recent gains had just been too rapid, considering mixed signals about demand and a rising dollar. Still, oil prices are more than 20% higher this year. And the National Football League has announced a new series of long-term TV deals valued at $105 billion. The package includes a historic contract giving Amazon exclusive rights to Thursday football broadcasts. That's a first for a streaming company. CBS and Fox will keep the rights to daytime games on Sunday. The deal starts in 2023 and runs for 10 years. Global news, 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Percent of the world's trade travels by sea. At any given time, around 5,000 ships are on the ocean carrying containers. Without them, the global economy would collapse. Many of those containers pass through here. Singapore, the world's second largest port. The industry accounts for 7% of the country's GDP. But the industry is under pressure. The uneven recovery from the pandemic is creating a shortage of containers where they're needed most and driving bottlenecks at major ports. It sent freight prices soaring.
Since the beginning of COVID-19, these are levels of shipments that we've never seen before.
Chinese New Year marks a seasonal time for freighters when rates are renegotiated for the next year. Companies must choose whether to swallow the financial hit or pass on the cost. It's a decision that could bring new headwinds for the global economic recovery.
How can somebody remember things that happened 80 years ago? How do you do that?
David, it's easier to remember 80 years ago than what I had for lunch today.
The alternative to a rules-based order is a world in which might makes right and winners take all. And that would be a far more violent and unstable world for all of us. I said that the United States relationship with China will be competitive where it should be, collaborative where it can be, adversarial where it must be.
Secretary Blinken, what a moment in Alaska. We'll return to that moment in just a moment. From New York City for our audience worldwide this morning, good morning to all. Alongside Tom Keene, I'm Jonathan Ferro. Lisa out for a long weekend. She'll be back with us on Monday. Here is the price action. Equity futures up 12 on the S&P 500. We advance 1/3 of 1%. Yields in a basis point. Stability there after a look at 175 in yesterday's session. 169.62 and in a basis point. Let's talk about crude just for a moment. Up 0.6%, a 60 handle. What a range this week. We saw 66 intraday on Monday, 58 yesterday. We closed lower by 7 percentage points. And Tom, it's a story of stability this Friday. Stability in crude, stability in rates, and stability in the equity market too.
Stability to get to Friday, and we're doing that, and get through the weekend, and then we'll reset from there. I would suggest we'll reset into a new demand in America, domestic economic demand. There is no stability in our foreign relations. We were stunned yesterday, all of us, by what came out of Anchorage. I asked Kevin Cirilli, I don't know, 10 days ago or so, are you going to Anchorage? Well, I guess he should have. He would have been warmed by the fireworks. Our chief Washington correspondent joins us, not in Anchorage, but in Washington. Kevin, I go back to February 1972, Henry Kissinger, the Cathay Hotel in Shanghai, piecing together the Shanghai communique. What was the communique written yesterday in Anchorage?
Game on, essentially. And look, I appreciate that comment, Tom. Look, I think as we move forward here, there was a clear resetting by the Biden administration in tone, but not in policy from the previous administration. That was my biggest takeaway. Either way you look at this, from the body language in the room or the tone from the Secretary of State, but from the policy standpoint, not much has changed in terms of what the objectives are from the previous administration to the current one.
We are constrained on time, Kevin. I'm going to go to the emotion of the moment. Every expert writing on it. Yes, there's Hong Kong and the new realities there. What are the new realities across the Formosa Strait?
You know, I think you get to a point where the broader relationship is incredibly strained, and it is in need of repair.
Kevin, we talked yesterday about how impulsive foreign policy would be with this administration, or whether we'd return to that story of orchestrating these things before they even happen. Diplomats getting around a table and saying, we're going to send our delegate, you send your delegation, we'll get around a table and this is what the outcome looks like. Yesterday felt impulsive. What happened?
You know, two things, and I think we alluded to this yesterday, but I think it bears repeating. I mean, there's this sense in the business community that the issue of energy policy is something that will unite the U.S. and China. But I got to be frank, here in Washington, that's not meshing with my reporting, because when I talk to Republicans and Democrats and what they're noting about the human rights abuses in China by the Communist Party, especially in the Xinjiang province, where half of the global supply of polysilicon, a key metal for the development of solar panels, comes from, you can't detach the two. And when you've got a global spotlight on Beijing, and just next year with the Olympics, you can't detach that away from this as well. So I'm curious to see what the conversation is in Europe as well as Australia about specifically the Xinjiang province, because it's one thing to have a semiconductor shortage or a semiconductor chip shortage. It's an entirely different to think about where these solar panels are coming from and being made, and how they're being made. And that how is going to be, I think, the most untangible variable going forward for the U.S. and China. The second you get Hollywood talking about the Uyghurs, the second that you get progressives talking about the Uyghurs, that will elevate the conversation to a whole new level. That hasn't happened yet, but it feels like that's the direction that this is going in.
Okay, Kevin, you've taken us there, so let's discuss it. In the United States, if a company is facing severe social issues, social justice issues, the consumer base in America, increasingly progressive, will isolate that particular brand, that particular company. We don't see the same thing happening on the international stage in China. Do you see that changing anytime soon? Because if the consumer base does not respond to this in a way that they do with companies, or hold companies to the same standard in China as they do here in the United States, then do you see any of this changing anytime soon?
Look, I think based upon my reporting, when I talk to people, to China experts, they would suggest that no, China's not going to change that. But here we are in a global economy. This is a test for 2021. Will the global economy move China toward the West? Secretary Pompeo raised the question during his speech at the Nixon Library more than a year ago, in which he said that they have not been. So, you know, that's the key question.
Kevin, it's a counterfactual, but let's go there. If Secretary Pompeo had traveled to Anchorage, would he have gotten the same lecture Secretary Blinken got?
Yes. But again, I think based on my reporting, I see so much more unity on the issue of China. And I go back, and I don't mean to be a broken record, but I go back to Senator Kevin Cramer, who said that the issue of China, national security policy, has become low-hanging fruit. In Washington speak, that means any bill that comes on China will pass without any controversy.
What can China do? How does China respond to the low-hanging fruit and the dialogue to come?
They have to look. I think I'm not gonna tell Xi what. I think
everyone else
is he gonna listen to Delco?
Well, Kevin, let me jump in and put this question a different way. These are the words of Secretary Blinken.
I didn't ask it.
These are the words that he used. The relationship with China will be competitive where it should be, collaborative where it can be, and adversarial where it must be. We've seen the adversarial part of this. It was in the last 24 hours. We know where the United States need to be competitive. Where it's not clear to me still is where they can be collaborative. Where can they be?
You know, I think when you look at the global supply chain, I think that there's a clear sense as to you've got the world's two largest economies, and from an economic standpoint, that they want to be. I think the way President Biden described it, were economic partners, and I think that partnership is obviously something that could be explored. But Taiwan, Hong Kong, what's going on in their waters, the human rights abuses. All of that is just leading to a moment that, candidly, I think it's going to be more interesting to see how the Europeans react, and how specifically certain European countries react, and whether they align themselves back with the West, or they continue to make inroads with China. And I will say this, and this is the final point, and I think it bears repeating, the influence in terms of technology in South America and Latin America can't be underestimated as well.
Kevin, here's the final point, Kevin.
Tommy's eating
What's your bracket look like?
Oh my gosh. I'm so, I didn't do, what was it? What's the terminal thing?
bracket
go. I missed it. I missed the deadline. Matt Sherman was all over me.
Kevin, go. Kevin Cirilli.
I know.
Down in DC. Thank you. Your equity market turning over. We're down off the highs. Still positive, a tenth of 1%. Let's get it back on the rails. Equities up, yields lower. This is Bloomberg.
Women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
I think what we've seen during this period of time is that communicating via video is not a fad, that we are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
From New York City for our audience worldwide, this is Bloomberg Surveillance live on TV and radio, and here's the price action this Friday morning in the bond market. This is where it all begins and ends, and it's been the story over the last month. Stability is the story of this morning. Yields come in a couple of basis points on 10s, just south of 170 on 30s. in and around 240. We come in a couple of basis points there as well. That spread between the twos and tens, about 153 basis points today, through 160 just briefly in yesterday's session. And what happens here has had huge implications, ramifications for what happens here. Switch up the board into the equity market. Stability in bonds, stability in equities. The Nasdaq bouncing back. The Nasdaq 100 down hard yesterday, 3 percentage points lower, up about 0.5% here. On the S&P 500, we advanced a little more than 0.1%. Wanted to sit here though just for a moment. Finish on this. Switch up the board. Last one. The ETF tracking 20-plus year treasuries. That is down, and down hard year to date. And Tom, the question that I've got at the moment, as duration sells off, longer dated maturities sell off, and people start to think a lot more about the risks around that, is how do we recap the quarter we've just had in the next couple of weeks when we look back? What does the look back look like, and how do people respond to it? When you look back at the carnage, the damage done year to date, at the longer end of the curve for long treasuries.
That's the smartest chart, John, you've done this week. That's a really important chart. We make a joke, folks, about the 97-year Austrian piece down 24% in price, but out long duration, it is a bond bear market.
Looking forward to catching up with Mike Schumacher on that from Wells Fargo in just a moment. Let's get you some movers. Rough for energy yesterday, Romain. A little bit of stability this morning.
Yeah, rough for energy, a little bit more stability today. Investors, of course, looking for either bargains or at least companies that they think could be resilient. You want to look for a company maybe that has good revenue growth, that has good pricing power, and more importantly, that's also keeping a lot of its capital expenditures in check. There's only a small handful of companies that can claim that. FedEx, one of those companies, their fiscal 3Q earnings really knocked it out of the park. You saw all of those metrics improving. They reinstated their guidance, which they had suspended a year ago, much more bullish than what it was prior to the pandemic. Remember, FedEx had said prior that they expected to get to 100 million packages a day by 2023. They're now saying they're going to get there a year earlier in 2022. 86% of that growth going to come for e-commerce. Not only are they getting a boost from e-commerce, but they said because of all the commercial airlines that have been sort of pulled back, all those flights, all of that cargo that would have normally gone into those planes, a lot of that is going into FedEx's freight business. So they're getting a boost there. UPS also a beneficiary of this. So interesting pandemic dynamics. But then you take a look at Nike here. Their earnings were great, but their sales were down, and a big part of this reason was not because they couldn't really sell product per se, it was because they couldn't even get that product into their inventory. They talked about some major delays with shipping, major delays in ports. In fact, their inventory at one of their main ports dropped 20%, Tom. So if you were out there trying to get those new flywheel lows, you weren't going to get them on time.
I'm looking at it, but I'm going to high cut. Romain, what I find interesting here is what we heard from Adidas, fold that into Nike,
Adidas,
which is, no.
Here we go. Romain, you know what you're starting here, don't you?
And it's Nikkei, or it's Nikkei. Okay, fine. Whether it's Adidas or Nikkei, is the retail store dead? What did you learn about that?
No. In fact, we've had a lot of folks on who've talked about this, and they say, look, they think that the brick and mortar model is certainly alive and well. It's not alive and well if that's all you do. Nike has sort of been emblematic of sort of that, quote, omni-channel thing where they've gone direct to consumer with their website. They have these sort of destination sort of brick and mortar locations, many of those which have already reopened. That's a popular brand. If you're a less popular brand, you're doing well. We heard from Burlington, which is, former Burlington Coat Factory, a company that has basically no real e-commerce presence, and they actually did incredible during the pandemic. TJX, another company in that space that's done well on his brick and mortar side. So, you don't necessarily have to be an e-commerce company.
Do you see, John, he talks differently when he wears a tie versus a bow tie?
Does he?
Can you tell the difference?
I can.
I can tell.
I have more energy. Well, you know how long it takes to get that bow tie tied, Tom?
A little less abrasive, mate. I don't know what that's about.
What else do you have? You done or not?
Don't gloss over this, Tom. I think this is important. Romain, you were there for those Nike numbers, and I think we're going to see more of this. How much more of this do you anticipate in the few weeks we have, weeks we have of March, the few months ahead?
Well, if you're talking about the supply issue, this is a big issue here, and it's not just Nike. We've heard from other companies that have talked about these port backups here. Right now, the general consensus is this could drag on until the summer months here in the U.S. before it gets sorted out. You have big companies like Nike that can sort of weather this storm, but it's kind of those second-tier companies that are really getting hammered here.
Romain, do you have Purdue in your bracket?
Did you? No.
You didn't get the memo?
I didn't. I don't know what you filled out. I got Iowa and Baylor going to the championship game. Baylor winning it all.
I disagree.
You can follow my bracket. I think you still got time to copy mine.
I got it. Well,
Yeah.
Do we actually have
and I would
time
do
to
better.
copy yours?
Yeah, I think 9 a.m., right?
Can I just do a straight replica of your bracket?
Well, yeah,
Yeah,
just
John
don't blame
should.
me if you lose it all.
I'm not going to. Don't worry. Romain, good to see you.
Romain,
Thank you.
so much. This is the most important conversation of the day. Surprise, not if you're a bond person, but quite frankly, if you're an equity person. There have been shifts in the market, and what that means is the adults in the room have to readjust and shift at quarter's end. That's 10 days away. Michael Schumacher joins us with Wells Fargo from Cornell and Sloan, somebody with decades of experience in bond bear markets. Michael Schumacher, George Borey told us we're in a bear market, did that a couple days ago as well. You've done the math on how adult pension plans, the defined benefit plans, must rebalance. What does that mean for our listeners?
Yeah, Tom, it's interesting. We expect the biggest flow by pensions in 10 plus years into bonds, out of equities. To put numbers around it, call it 26, 27 billion this morning, something like that. The exact number is not that critical. The point is the biggest flow in a very long time. We think that takes place starting probably late next week and lingering on toward the end of the month.
What will be the nature of that, or is it a mystery? Do we know what they'll sell in equity, and do we know what kind of paper they'll buy in fixed income?
We know which equities have done the best. It's been the small caps. So if you were thinking about rebalancing on a formulaic basis, it would be sell small caps, then large caps. In the bond market, it's pretty simple. Buy the back end, buy long duration, buy credit.
Big backup in the long end, 10s, 30s in the Treasury market. Mike, you've been waiting for this moment. It's here. And we've been asking how much oxygen is left. Is the path of least resistance still higher for Treasury yields? What are the answers to those questions now?
Yeah, John, it's interesting. So if you think about the next couple of weeks, we're essentially neutral for the pension flow reason, and also Japanese fiscal year end starting April 1st. But if you take a longer perspective, I think it's interesting to look back to the taper tantrum. Everyone does, so why not us? And during the tantrum, real yields on the 10-year Treasury went from very negative to positive. Now, today, the real yield's about minus 60 basis points. Eventually, the Fed tapers. We think at Wells Fargo that probably happens early next year. So if that's enough to push reals up to around zero, and if inflation expectations stay about where they are, that would put 10s well north of 2%. So we think 2% is in play this year.
The move towards zero on reals, Tom, this is what you brought up a couple of hours ago. Yep. So let's talk about the nominal yield at zero in Japan. A band of 25 basis points either side, Mike, a commitment to keep the 10-year maturity there. And you're talking about a nominal yield in America getting out to 2%. We're talking about a bond market with a nominal yield that is negative. Just how wide are these spreads going to be, Mike, in the next 12 months?
Yeah, spreads can be huge, John. It's interesting when you consider the idea of yields going up. Typically, the U.S. leads the way, maybe Australia matches it. But if you consider it in the context of a beta, let's say, the Boone's beta is maybe 5 or 6 basis points per 10 basis points in the 10-year Treasury. JGBs don't move all that much, so maybe the beta is 1. So rising yields in general should push those spreads out. There's no particular speed limit, so it's really a function of just how aggressively, how high the 10-year Treasury yield goes.
Michael, I want to go back to what we heard from the bond expert, John Farrow, where he said this bond moment is here. I think that really captures the moment. What does a bond bear market look like? So few people actually know, not negative 10%, not negative 18%, but even a bond bear market of negative 5%. What does that look and what does that feel like?
Yeah, Tom, one of the big implications we've been thinking about is what does it mean for mutual fund investors? So a lot of people, when they buy bond funds, think, well, I'll make some money, not a ton. It's not like an equity fund, but I certainly wouldn't expect to lose any money. And yet when those quarterly statements come out in a couple of weeks, there's going to be a lot of red ink. So we're wondering, what is the staying power? Our hunch is that people probably hang in another quarter or so, but if the numbers look as bad or perhaps worse at the end of June, then I think you got the risk of significant outflows.
John, I can't say enough how important this is. It's not the first envelope, it's the second, and it's really, John, the third envelope with a little bit of red print on it.
So let's get to that June meeting over at the Fed, Mike.
Exactly.
How different is that June meeting compared to the one we just saw?
Could be very different, John, and here's why. The challenge for Chairman Powell was to talk about inflation, not when it's low, but when it gets high. What I mean by that is the Fed has shifted to targeting average inflation. And if inflation ticks up above 2%, which it may well do in the next few months as these low numbers from last year roll off, then the chairman's going to get a little uncomfortable. People will say, well, okay, fine. You tell us you're going to target average inflation, but now inflation's above 2. How long do you wait for that average to catch up? That's when the chairman really has to be strident and make that point time and time again that the Fed is intending on staying low for a very long time. We'll see if the dots cooperate, frankly.
Mike, looking forward to catching up then, that's for sure. Mike Schumacher, Wells Fargo Senior Macro Strategist. We'll catch up with Mike before that time. So here are the dates, put them in the diary. Tom, April 28th, that's one Fed meeting. Here's the one with the forecast, the updated forecast, June 16th, the middle of June. What does that meeting look like?
No, I
How
think
different is it?
I agree with the forecast. It is different. I've been focused on April 28, but John, I do admit that June meeting, and Michael McKee has said this, with the forecast, and what's so important there is quarter ends here, you're going to have economic data there, and by the June and into July, you're going to get a feeling for the second quarter as well.
Oh, base effects have kicked in. Base effects have kicked in big time in the next couple of months, Tom. GDP, maybe growth has even peaked. And that's going to be an interesting conversation to have. Expectations around growth may have peaked as well. And then we start talking about, before we even reopen this economy and really get roaring, we'll start to have a conversation more and more, Tom, in the next several months about 22
certainly
and what 22 looks
certainly
like.
The conversations this week, John, there's a massive mystery about that glide path, that decay off of whatever the maximum peak is. I don't think anybody has a clue.
The deceleration from 21 to 22
very nice.
and how you want to be allocated to this market. Coming up on this pandemic, Dr. Peter Hotez, Baylor College of Medicine Dean, a really important conversation. They did, Tom, but we're going to talk about all things medicine next. Vaccines, a pandemic, 2.5 million vaccines per day on average in the last 7 days in America. Phenomenal numbers, and a reason, together with fiscal relief, why we're talking about American exceptionalism in this global economy, and certainly relative to what is taking place in Europe. Euro dollar 119.06, your bond market yields in 3 basis points. No bracket in Europe, 168 on 10s. In the equity market, up 9 points on the S&P 500. It's like babysitting. Tom, we have the European Football Championships in the summer. We'll do a bracket for that,
No one cares, the bracket.
We'll do a bracket for that.
But the tots aren't in it, so
who cares? Do you care about basketball, really? Do you? You ever played? You would have been good at basketball.
I picked the blue uniforms except for Purdue. I have to go with Purdue by mandate.
I know that's
in my agreement.
That's the cheat guide to Tom Keene's bracket. Okay. Futures up 9. We advance 0.2%. This is Bloomberg.
With the first word news, I'm Rishka Gupta. Russia's Vladimir Putin is still hoping to have a public conversation with Joe Biden to clear the air between the two presidents. That's according to a Kremlin spokesman. Earlier this week, President Biden accused Putin of being a killer. Moscow responded by recalling its ambassador from Washington. That's a traditional way countries have shown their displeasure. In Alaska, the first high-level talks between the Biden administration and China turned tough almost immediately. Secretary of State Antony Blinken raised concerns about cyber attacks, the treatment of Muslim minorities, and Beijing's control over Hong Kong. Chinese officials criticized the U.S. over the killing of Black Americans and called the U.S. the champion of cyber attacks. The French government is locking down several regions for a month, including Paris. President Emmanuel Macron is trying to contain a third wave of the coronavirus pandemic. Only schools and essential businesses will stay open. The new measures are expected to take 0.2 percentage point off France's annual GDP. The global insurer Chubb has made a $23.2 billion offer for its rival Hartford Financial Services. It would represent a 13% premium to Hartford's close on Wednesday, and it would be one of the biggest deals in the insurance industry in years. Chubb says it's gotten no response yet. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I have asked the Securities and Futures Commission and the Hong Kong EX to work together to explore the viability of our own Hong Kong version of specs. We remain very confident on the competitiveness of the Hong Kong stock market.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
The committee has come to a clear scientific conclusion. This is a safe and effective vaccine. Its benefits in protecting people from COVID-19 with the associated risks of death and hospitalization outweigh the possible risks.
There is some reputational damage to address in Europe, that is for sure. Emma Cook, the European Medicines Agency Executive Director on the AstraZeneca vaccine, and the spat that we've seen between European nations and that pharma company over the last couple of months on several issues has just been phenomenal for all the wrong reasons. From New York City this morning, good morning. Alongside Tom Keene, I'm Jonathan Ferro. Lisa Abramovich back with us on Monday. Here's the price action. We keep going back to this single word, stability. We have a little bit of stability in today's session to close out a really choppy week. In the bond market, yields in by 2 or 3 basis points on 10s to 168.21. Euro dollar not doing much at 119. The S&P 500 futures up 8 points, up 0.2%. Nasdaq 100 futures up 0.6%, and Tom, crude lower, aggressively lower in yesterday's session by 7%. Today up 0.4 to 60.28.
I noticed Brent crude 63.44. That global price from 70 down to 63 gets my attention. We're going to stop the show right now because John Farrow lived this. He was ensconced in London as we looked at this pandemic and we looked at the reality.
Hello guys, and welcome to SD Trader channel. Hope you're okay. And straight away, I want to place an order. I'm looking to sell short euro, and the price I'm looking to sell for 119.05.1. Okay, guys, if you're up to trading today, and if you would like to sell short euro, this is your chance. We received the order. From our indicator. Indicator shows that it's time to place an order to sell short euro. So let's see how long it will take us to reach this level. Also, at the same time, I'm going to place an order. Let's see, to buy, I think we're going to buy right now Japanese yen. Let me see. Let's see what's happened, what is going to happen with this candle chart, with this candle, last one. If it will start going down, I'm going to place an order to buy. Let's see if it will move higher. They are not my chances to place an order. So hope you had a good evening yesterday. We did well on Bitcoin, on especially Swiss franc. Yeah. Yes, I'm going to place an order to buy at 108.789. Okay. I'm going to place an order to buy at 108.789. Okay, order placed. And let's see if you're up to Japanese yen. You're welcome to place an order if you want to follow this trade. So 2 orders right now available for you. One of them I probably have to cancel it because, as you can see, euro moved down quite substantially. Let's see what's going to happen with this candle. If it will move down, I will have to cancel it because it's day trading, guys. It's not like we are planning to hold it for several days or weeks. We're planning to get profit as quickly as possible. Okay, I'll speak to you in a couple of minutes. I'll speak to you later. It's look like the euro changed its direction. So if it will move higher, I will hold. If it will start moving lower, I will cancel this order. Same applies to Japanese yen. Stay safe.
The issues in France around this vaccine would spill over culturally to the issues in Africa as well. When you say we could see a disaster, can you describe what that disaster would look like?
Well, the disaster is, it looks like the South African variant, the B1351, is accelerating now up into Malawi, Mozambique. And even though Africa overall has done better than many expected during 2020, that grace period could end as this virus starts to accelerate. And the world has been very focused on very high-tech innovations, mRNA vaccines that'll never filter, or I don't think will filter to the low and middle income countries. Yes, Pfizer-BioNTech sent 235,000 doses to Rwanda. That was great, but look at the need. There are 1.1 billion people living in sub-Saharan Africa. If we need 2 doses of most of those vaccines, that's 2 billion doses. So far, it's a drop in the bucket, and there's no real plan for what we do. We're trying to accelerate a low-cost recombinant protein vaccine with another Indian producer, Biological E, and that's going really well. So hopefully we can fill that gap. But that's a potentially humanitarian crisis right there for Africa.
Are you receiving sufficient funding to do that, Doctor?
No, I mean, we had to raise a lot of that money privately from various sources, and here in Texas, enough to do the technology transfer to India. And now we're in discussions with South Africa and Indonesia, so hopefully that will come through. But you know, everybody went very heavy on the innovation, and innovation's important. We need to innovate in vaccines, but you know, at a certain stage, you need some traditional, low-cost, durable vaccines for low and middle-income countries, and there was not enough attention paid to that.
Now, Peter Hotez, thank you so much. I notice your bookshelf behind you. No doubt Walter Isaacson's new book on genetics will take a place there as well. Peter Hotez of Texas Christian Baylor College of Medicine.
Thank you, Doctor.
With us today. John, you know, I look at the pandemic, I look at all that we're talking about, and there is an effervescence out there. We heard that from Tom Colicchio, the restaurateur, 1 week ago today.
Oh, things are buzzing, and for anyone here in New York City, they'll know it's very, very difficult to get a reservation in a New York City restaurant at the moment, Tom. Things are already opening up, and things are already booming back before we even get everyone vaccinated. I just want to re-clarify something I said earlier about the numbers in the UK. 28 million doses given so far, enough to cover 20.7% of the population, and not entirely, of course, from the AstraZeneca vaccine. And just to compare and contrast that with America right now, 116 million doses given, enough for 17.7% of the population. Tom, to the doctor's point, though, we need to think a lot more about the developing world, a lot more about Africa that don't have access to these vaccines, and a lot more about the prospect of variations.
And David Malpass at the World Bank would agree with what you say, John, and frankly, Managing Director Georgiev at IMF has really emphasized this as well. John, what I would focus on, I said this last night at the dinner table, Brazil and Latin America are horrific.
Yeah, the numbers, not good. We're talking about a third wave in Europe, shutdowns in Paris again for 4 weeks. It's a very, very different conversation around to the rest of the world compared to, say, select parts of the Middle East, the United States, and the UK and China for that matter as well.
You're going to get a 59 on oil here, John.
169 on 10-year, 60 on crude, Tom. From New York, this is Bloomberg.
Okay, I was right. I need to cancel order to sell short euro. It didn't go higher. So for this moment, please cancel your order. So we're going to cancel order to sell short, but Japanese yen order to buy Japanese yen still on. So at this moment, please do cancel the order to sell euro. Stay safe, guys. I'll speak to you later.
Not only just COVID, but it's COVID related, but it's also stress related to job. I think COVID probably just sort of was the nail in the coffin for a lot of us. Having the destruction room here is also a very healthy outlet. I do not encourage it as something that we do on a regular basis, but I do find that when people come in, being able to break plates, being able to write out whatever's on their mind and letting it go, being able to just take out their frustration and their anger.
Come to a place like this and be able to break some stuff and release some tension without going to jail.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars. Only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Valuations, particularly sort of technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Savings rate, I expect to stabilize at a much higher rate than it was before the pandemic.
We think there's a psychological release that's available here.
While traffic may continue to be weak, sales are improving.
The bearish argument around runaway inflation is not going to come to fruition, and they're kind of fattening themselves up for the slaughter.
Where there is danger is in some of these markets that have been swept up into a speculative frenzy.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene, a simulcast, Bloomberg Radio, Bloomberg TV. Abramowitz, the pendulum of day off. She is so gone today. Well needed. We wish her
I think it's important. We came into 21 talking about synchronized global growth. Who's talking about that now? Big growth figures, sure. But beneath the surface, beneath those headline forecasts, America great, China stable, Europe, not so much.
John, I want to touch on two important ideas, and one is your property this afternoon, the real yield. That's what our guests are talking about, which is the real yield from a negative 1.0% up to negative 0.60. That's come fast, and you wonder, can it continue that linear move?
Mike Schumacher of Wells Fargo talking about that move to 0 on reals and 2% on nominals. So what you get a much wider spread versus the rest of the world. Japan pinning it to the floor at 0 with a 25 basis point band on either side. In Germany, the depot rate staying negative for years to come, maybe. So the Bund on a 10-year maturity could be -2. And we could be talking about really wide spreads. The Treasury market being the high yielder in a world of low yield still, because these central banks are just not going to let this go.
John, before we get to data, I really want to talk about what we've learned today about the uproar in Anchorage, Alaska. You go back to the Shanghai communique of 1972, there was no communique yesterday.
Let's be clear about this. We've talked a lot about diplomacy, and we have experts, former diplomats, current diplomats that come on this program, and they will tell you that diplomacy is well choreographed, well orchestrated, that the individuals get in the room way before the high-profile guys do, and they basically orchestrate the outcome. What happened yesterday, what we were meant to see, this is what we were meant to see. The US delegation, Secretary Blinken, talked for a couple of minutes. The Chinese delegation talked for a couple of minutes. What we actually saw was the Chinese delegation go on for a whole lot longer. And then what happened? Secretary Blinken, instead of letting the press leave the room, told them to stay so that he could snap back. And this became what seemed to be quite impulsive, though I have to say Secretary Blinken seemed very calm and collected. And what it comes down to continuously between these two countries, China seems to be very comfortable having a conversation about global economic issues. When you talk about human rights, they push back aggressively about the social injustice taking place within the United States. And we got a little sample of that, some appetizer for maybe what's still to come in yesterday's talks in Alaska.
Yeah, well, in talks in Alaska and another airline, we're going to have Helene Becker with us here in a bit. Alaska Airlines opening up nonstop flights of some flavor as well. John, let's do the data right now. Green on the screen. I'm sorry, the NASDAQ down 8% is not a correction.
Got a bounce back this morning, up 66. We're up 0.5% on the NASDAQ. On the S&P, Tom, up 8. The S&P 500 up 0.2%. In the bond market, I think we can say we've had a big move year to date on 10-year treasuries. On the week, up about 6 basis points. On the day, down about 2 or 3. Tom, back to 168.21 on 10s.
John, do we need to talk about Bitcoin? You and I ignore it as best as we can. 59,000? What does Bitcoin do over the weekend?
I'm still trying to understand Bitcoin, so I try not to talk too much about it. Not because I advocate one way or another, just I'm trying to understand the universe in a way that I can actually add some value to the conversation.
Yeah, Brian Levitt, ordered by his general counsel not to talk about Bitcoin, and joins us right now with Invesco Global Market Strategist as well. We'll avoid it. Brian, there was a theory 2 or 3 levels ago about international investment and a recovering Pacific Rim. Dovetail in EM disappointments of the last couple days and weeks with what we observed, the tension in Anchorage yesterday. How is the Pacific Rim doing?
Yeah, so China actually has emerged from this, as most people know, in quite good shape. You're right, the economy is quite stable there.
Okay, guys, it's time to play stop on profit for Japanese yen, and it will be 108.01. Okay, stop on profit 801. Stop on profit placed. So you have to do the same, and whatever happened, like I always say, you will not end up in profit, in loss, sorry. You don't have to put stop loss because we're already in profit, and we never put. Our strategy allows us, it was designed not to lose any money, so it allows us to put stop on profit and not stop loss. Okay, let me point out that this is actually stop. People will understand what it is. I will highlight in the yellow color for newcomers, and let's see. 108, sorry, it goes to 801. Like this. Okay, I'll speak to you later. Stay safe.
Ultimately fade as we move out beyond 2021.
Well, let's move out beyond 21. This cycle moves quickly, Brian. We've been pricing in all of 21 throughout the last couple of months. In fact, since the beginning of November, we've been pricing the boom that is 21. When do you start thinking about deceleration in 22?
Well, I think that investors need to keep their mind on deceleration in 22. Now, I think this recovery reflation trade plays out for a bit. You know, your value-oriented parts of the market get their day in the sun. But ultimately, you know, this idea that we can't own anything long duration, that interest rates are going to keep going up forever, I caution against that. What you see as you move out into 2022 is, look, we all have pent-up demand. How long does that persist? We know that this income replacement that you get in the fiscal deal starts to fade as you move out into 2022. And let's not forget the long-term structural forces against inflation, like an aging population globally, automation of the workforce, new technology. So I'm not ready to sell anything long duration. I think growth stocks will be back in vogue as we move out into 2022.
Brian, I'd really underline the new technology, which is, of course, a great mystery. Paul Romer with Bloomberg earlier this week, the laureate. Brian Levitt, how much cash is really out there? I get all these trillion numbers, but when Invesco sits down and calculates out the investable cash that's out there waiting to find a warm spot, how much is it? Is it a lot? I mean, I'm not looking for a number answer. I'm looking for something Friday scientific. Is it ginormous or is it a lot?
It's a lot. I mean, it's ginormous. I mean, you had $1 trillion go into money market strategies last year. You've got, you know, I mean, even if you think about the amount of money that's just sitting in government-related bonds, you're looking at a few trillion, and you add it all up, there's a substantial amount of money sitting on the sidelines. Even if you think since 08, you've had far more money, a ginormous amount of money go into fixed income strategies versus equity strategies. And yields have come up a bit, but nonetheless, the Fed's still telling you they want to inflate away a good percentage of it. You're getting zero in money markets. The Fed wants greater than 2% inflation. That's not a great deal. Ultimately, I think that money continues to find its way into equities and credit. And let's remember, a lot of this support on the fiscal side is going to end up in markets. It's some of it is finding its way into middle-income household pockets, and that's going to find its way into markets too. So I would say asset price inflation is a good part of this story.
Brian, let's stop talking about managing other people's money and talk about managing your money. I understand it's young Carly's birthday today in the Levitt household, so happy 13th to the young Levitt. For you, Carly needs some money when she comes to New York City in about 10 years' time. If you had to buy and hold for a decade for your young 13-year-old, where would that money go today, Brian?
Well, let me first say I hope it's a decade before she's going to New York City to hang out with her friends. I assume it's going to be a little bit sooner than that. But I think that you have a trade here on value stocks. But if you're looking out long term, 10 years, you want to look for structural growth businesses globally. I would think that a lot of those are going to be in the United States. Some of those are going to be in the emerging markets as well.
Brian, is she trading GameStop off the couch?
Not yet. Maybe I should teach her to. Not yet. I just feel bad that, last year the friends were honking the horn on the street to celebrate the birthday. This year, a little bit better. We're celebrating in the garage. Maybe by 2022, we can go inside. Yeah.
Have fun, Brian. Happy birthday.
Thanks a lot. Appreciate it.
Enjoy the celebrations. Thank you, sir. Brian Levitt there of Invesco, the global market strategist. That irony, it's not lost on anyone, is it, Tom, this moment that we're talking about? Last year, it was the economy bad, markets great. This year, economy great, and people having a conversation about whether markets will have to turn lower.
Yeah, I mean, there's a financial end of it. I'm going to go back to buried in the headlines today, John. Dr. Fauci going after Senator Rand Paul of Kentucky. Are we still going to believe in science? Science got us to where we are right now, John, in what, 6, 8,
so yes,
10
Tom,
months?
Yes, and the vaccine push has been terrific, but I do think there was some damage done this time last year on the mask front. I do think there was some damage done, and we can't gloss over that. We were all told about not wearing a mask, and then a month later told we all needed a face covering. Then we were told face coverings weren't good enough, and now we're told 2 masks. And I understand the science changes, but I think a lot of people got the feeling that they were lied to 12 months ago, Tom. and that needs to be repaired.
No, the confidence needs to be won back. Helene Becker will help us with that, John, right?
Looking forward to that. On the airlines, on FedEx, Helene Becker, Coward, senior research analyst. Timely conversation coming up. Futures up 8 on the S&P 500. We advance 0.2%. This is Bloomberg.
With the first word news, I'm Rishika Gupta. The first top-level talks between the Biden administration and China were bound to be confrontational. Now the question is, can the two sides find a way to cooperate? In Anchorage, Alaska, diplomats from the world's largest economies criticized each other over everything from human rights to trade. Secretary of State Antony Blinken accused China of undermining global stability. The European Union has a chance to put coronavirus vaccinations back on track today. Regulators have given AstraZeneca's vaccine the all-clear. EU governments, including Germany, France and Italy, say they'll immediately resume administering the shot. Several countries suspended its use after reports of blood clots in some patients. The Biden administration is considering whether to impose more sanctions to block construction of that gas pipeline from Russia to Germany. The Nord Stream 2 pipeline is almost complete. Bloomberg's learned the U.S. may sanction the project's parent company. Penalties on other companies are also a possibility. And American mortgage lenders are likely to now focus their resources on those homeowners who still have incentive to refinance. The average homeowner left within the Fannie Mae 30-year MBS index is paying an interest rate of 3.8%. Mortgage rates have risen steadily since January and are now just under 3.1%. The National Football League has announced a new series of long-term TV deals valued at $105 billion. The package includes a historic contract giving Amazon exclusive rights to Thursday football broadcasts. That's a first for a streaming company. CBS and Fox will keep the rights to daytime games on Sunday. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
90% of the world's trade travels by sea. At any given time, around 5,000 ships are on the ocean carrying containers. Without them, the global economy would collapse.
Many of those containers pass through here, Singapore, the world's second largest port. The industry accounts for 7% of the country's GDP.
But the industry is under pressure. The uneven recovery from the pandemic is creating a shortage of containers where they're needed most and driving bottlenecks at major ports. It sent freight prices soaring.
Since the beginning of COVID-19, these are levels of shipments that we've never seen before.
Chinese New Year marks a seasonal turn for freighters when rates are renegotiated for the next year. Companies must choose whether to swallow the financial hit or pass on the cost. It's a decision that could bring new headwinds for the global economic recovery.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
In the United States, it is an absolute core national security agreement across the political spectrum that China is the most critical adversary of the United States. The Europeans don't buy that at all. China is not their core adversary. And that's a real problem.
For some people, that's the problem. That was Ian Bremmer of the Eurasia Group and G0 Media President. Okay, there's going to be a multilateral approach, but can you get your allies to come along with you? From New York City this morning, good morning. Alongside Tom Keene, I'm Jonathan Ferro. Lisa Abramowitz back with us on Monday, taking a well-earned break, a long weekend. Here's the price action going into this weekend. We look like this on the equity market. Up 0.6% on the NASDAQ 100, on the S&P up a third. Yields in 2-3 basis points on 10s to 168. We have a 59 handle on crude. We do not advance. We did earlier this morning after a 7% plunge on WTI. What a range we've had this week on both crude and treasuries as well.
Oil.
Stability, Tom, on euro dollar, 119.01.
Oil's a shock. I've got to read it on that. Of course, Javier Blas helping us.
Totally.
Javier Blas helping us out with that. John, review, what was the why yesterday on oil? I sort of missed that, to be honest.
Can't put my finger on it. Took on a life of its own, to be honest with you. And a lot of people were talking about maybe we're priced in a recovery too quickly, given what's happening in Europe, shutting down again. Don't know, Tom.
The heritage that John and I have is to talk to experts, and if you know the name Cowen, you know they own aviation. With the legendary Kai von Rumer and the ever so younger Helene Becker, they have been at the top of the heap on airline analysis, and we're thrilled Helene Becker could join us this morning. Helene, within your note is the rollout you are guessing at, which is Cancun at some point, and then we're going to jot off to Paris as they go into lockdown this weekend, and somewhere way out in 2022, we're going to be able to go to Asia. Can the airlines wait that long? Are the airlines in control of their destiny?
I think they are, and it's good to see you again, Tom and John. Nice to talk to you guys. I think they are in control of their own destiny at this point. Over the past week, we've regularly seen more than 1 million people a day pass through TSA, and we thought that that would be the case till about mid-May, and then around Memorial Day weekend, we think there will be a jailbreak, and we'll see regularly between 1.1 and 1.5 million people a day. And frankly, we think that's pretty close to pre-pandemic levels in domestic traffic. Right. People don't want to quarantine, especially, you know.
Okay, guys, I need to place stop on profit further for Japanese yen. I move just 1 pip higher, 108.1.9. Oh, actually, I'm going to keep just right here, 2 pips higher, right? Yeah, I'm going to keep 108.809. This is nice support level, and let's see what's going to happen with this pair. It's look like it moved nicely higher, so probably quite soon I will have to increase my stop on profit. If you're already into this trade, please increase your profit. So if the price will change direction, if momentum changed, you will end up with nice profit. Okay? Stay safe. Speak to you later, guys.
See them bringing back wide-body aircraft this summer in huge measure because Europe is still, for most of Europe is still closed. But when Boris Johnson announced his plan for reopening the UK in mid-May, EasyJet saw a 334% increase in bookings that night. Real. I know, and because people are sick of being home and cooped up, and they want to get out and about. And we're more worried about Europe than we are about U.S. airlines because of that, because Europe has been so locked down. And I think also people people don't want to wear a mask for 8 or 10-hour flights.
People are done with this, Helene. As you know, they're totally done with this. And what's amazing, before we move on and just speed on to the boom in the United States, we've got to look back on where we were. I remember talking to you in the depths of this crisis. It felt depressing. It was depressing. The likes of Warren Buffett, a legendary investor, dumped his airline stocks in April last year, and Berkshire Hathaway said, the world has changed. And Helene, so many people got this wrong because so much is coming back so quickly. Why is it so difficult to get a read on this industry?
It always has been for almost 4 decades that I've covered this industry. It's been very up and down. 2 or 3 good years, maybe 1 great year, and then 4 or 5 so-so or bad years. It's so cyclical and so dependent on consumer discretionary spending. And then, of course, business traffic, which you're kind of alluding to here. In the million people a day we're really not seeing much business traffic, maybe small and medium-sized companies who need to get out on the road to generate revenue, but we're really not seeing corporate business traffic come back yet. They're still worried about getting their people back to work. But we think that's a fourth quarter 21 event where people will start to get back on the road. We think maybe 80% of the way back by year-end 22. And then maybe the other 20% comes back over 23 to 26 or 7.
So let's talk about opportunities then, because right now everyone's on board with the domestic story here in America. Everyone's on board with the return of travel. Everyone's on board with the likes of Alaska, nicely leveraged to that story. Helene, when do we start to talk about the New York-London corridor reopening, the European story reopening? Is there an opportunity there now, or have we already missed that too?
Oh, no, I don't think we've missed it at all. I think United is the most leveraged to international traffic. 50% of their capacity is in international, bigger than both American and Delta. So I think that international corridor starts to come back probably September, October. I'm kind of hoping this summer because all of us canceled many trips to Europe last year. And I think we want to go back. And I think that by the end of this summer, enough vaccine will be in people's arms worldwide that we'll be able to see that start to reopen, but just start.
Helene, you know I love catching up with you. It's great to get you on the program. Helene Becker there,
Thanks for having me.
Senior Research Analyst. Thank you for being with us. Tom, my line in the sand, the vacation is booked, the end of August for the family in Italy, and I have no idea whether that vacation takes place or not. The flight is booked with American. Let's see if it actually happens.
I laud you, John, for having the foresight to do that, and frankly, almost the intellectual courage to do it, because the news of the last couple of days has really been difficult. John, a research note just in, which is really the first of the wonderful Friday information we will see. Alan Ruskin, who has joined us this week at Deutsche Bank, John, writes a classic Ruskin detailed note, and he says the real canary in our demand coal mine is going to be the U.S. current account deficit, and it's going to blow out to something unimaginable just because of all that demand.
What does that mean for this currency? We'll talk about that in just a moment. Coming up, Michael Gapin, Barclays Head of U.S. Economics Research, and dropping by to catch up with us on EM, Damian Sassower of Bloomberg Intelligence.
Damian, he's here for the bracket, John.
Dropping by for a little bit of basketball, then a rate hikes from Brazil, Turkey, and maybe one to come from Russia too. From New York, this is Bloomberg.
How can somebody remember things that happened 80 years ago? How do you do that?
David, it's easier to remember 80 years ago than what I had for lunch today.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
From New York City for our audience worldwide, counting you down to the opening bell on TV and radio. This is Bloomberg Surveillance. Here's the price action. I'll whip through things for you. Equities up 0.2 on the S&P, up 0.4 on the Russell, up 0.6 on the Nasdaq. We bounced back after a 3 percentage point loss in yesterday's session. We have some stability in the bond market for now. 2s, 10s, 30. Switch up the board. We look like this on 10s. Had a little look at 175 yesterday, pulled back, and again this morning we're down by 2 basis points to 168.56 on 30s. We come in 3 basis points to 242. Stability for now. Not so much stability over in EM. Let's finish on this. Emerging market currencies. This has got to be the story of the moment in global central banking, away from the Fed. It's EM. Brazil, a hike. Turkey, a hike. 200 basis points this morning. Russia talking about
okay,
a hike.
guys.
So what do we...
Okay, this is how it works. We just closed our position on Japanese yen at 108, 809. It just probably somebody, some institution really wanted to have our money, but we still end up in the profit. As you can see, it started to move higher. In our case, we have £200 in profit. In your case, it's all about how much broker pays you per pip. Okay, well done. I'll speak to you later. Good trade, by the way. Good trade. Good spotted, good trade. I'll speak to you later, guys.
The lira is down 60% over the last 5 years.
Damien, I'm doing intraday moves. Give me a break.
I mean,
I'll get the month chart up for you. Come on.
35% over the last 5 years. We need more than this. But, you know, I think it is a bit comforting to watch these currencies rally on the rate hikes for sure.
What more do they need to do, Damien?
Oh, God. Well, in Turkey's case, I mean, they have to get their locals to start trusting the currency again, right? I mean, the fact that they're holding a ton of dollar deposits, a ton of gold, and they're just, you know, they just remain offshore. They're not bringing their currency back onshore is a real risk there. In Brazil, it's a 95% debt to GDP ratio, right? They've got to bring that down. And, you know, myself included, you know, I was hoping after, you know, fiscal spending to GDP basically rising to 12% last year, coming back down to the single digits this year. Good luck now with Lula getting exonerated. And now I think in Brazil, the Supreme Court may even decide that Sergio Moro was biased and throw out all these convictions due to the car wash scandal. So, you know, there's a lot more going on here. And in Russia, as you rightly point out, today's 25 bip rate hike, I mean, we've got sanction risk behind this. I mean, you know, we may see sanctions on Gazprom due to Nord Stream 2. So, you know, these are real risks. And Biden calling Putin a killer yesterday probably doesn't bode well in the eyes of emerging market
investors. Probably didn't help in this currency market either. Damien, let's finish on this one. Did the Fed chair give them a helping hand this week?
Well, I think the Fed is clear in its message. After 20 years of outperformance, it is no longer going to support duration, and I think this market is going to pull on that thread until it snaps. So, you know, I would probably be staying away from emerging markets just in this environment. But, you know, things are definitely setting up nicely, and levels are looking a lot better.
Damien Cesar, thank you so much. Greatly appreciate it. With Bloomberg's Intelligence, their window into the credit markets of EM. Right now, Michael Gapin joins us. The only reason he's with us is PhDs at Indiana University, and he called up and said, look, if you're going to put Purdue in your bracket, you got to have me putting on at least a trumpet. IU, the land of James Bullard and Michael Gapin and their PhDs. Michael, so much of this is the recovery of America, and I really want to talk about the disparity of the always focused on East Coast versus the stability that we've seen in the Midwest. Has it surprised you to see the American resiliency and recovery given this pandemic?
I think if we go back to about a year ago, so first of all, good morning to both of you. I think it has. I mean, I've always been a believer in the dynamism of the U.S. economy, but even I was surprised how quickly things turned last year, and the economy was able to deliver goods and services to households in a way that it hadn't before. Business models were turned very quickly on their head. And in this case, we came out of it with an extremely strong manufacturing sector and goods side of the economy. As you note, a lot of that is still located in the industrial Midwest. I grew up outside of Chicago, for example, so it's very familiar for me. So it's not that I didn't believe in the economy, but yes, I think things were much more dynamic and turned much quicker than I thought could happen, given the immediate onset of the pandemic.
And some of that quicker is responsiveness or elasticity. What will be the elasticities of an age of over demand? If we get an induced boom economy, is that good or bad for us?
I think it's good for us, and the elasticity that we are counting on here actually is a return of employment, because we're discussing the marginal dollar going back into leisure and hospitality and service sectors, which are generally lower productivity sectors. So the only real way to increase output in this side of the economy is to hire more. So we're now expecting the elasticity to be in the labor market, where people who are sitting out of the workforce are not counted, as Chair Powell might mention, that the U3 unemployment rate understates true unemployment. We're expecting a lot of those workers to come back. If that happens, then you kind of get this malleable supply side of the economy, that supply side disruptions start to go away, and we get a bit of a temporary inflation burst out of this, but it's largely transitory. So I think that's in a sector that's often not viewed as dynamic, the services side of the economy. We're expecting the labor market elasticity, or the historical nature of the U.S. labor market, to have a lot more hires and fires than you might see outside of the U.S. We're counting on that over the next 24 months.
Michael, we've had a huge conversation this week about one key variable. Where does the savings go? Where does the savings rate go after the next 12 months? What does it look like? Where does the money get spent? Where do the checks go? And Michael, it's interesting that the market participants that have been on this program this morning are talking up a savings rate that gets drawn down aggressively. And Adam Posen of the Peterson Institute came on this program and said yesterday, hold your horses, wait, I don't think it's going to happen like that. What's your view on that, and how key is that variable?
I think it's very key, certainly for the near-term momentum in the economy. I would say that the savings rate's likely to come down. I'm not sure that it goes all the way back to pre-pandemic levels, so I would share a bit of what Mr. Posen said. But even if with that view, you're still talking about a massive chunk, or a very large chunk, of this estimated 1.82 trillion in excess saving. A lot of that still means it can come back. So I think there's two things at play. There's probably a structural move to a higher savings rate, but there's a lot of cyclical support in that savings rate too. If that cyclical support comes out, so precautionary saving goes away a bit, pent-up demand comes back, you can kind of serve two masters here, where I think the savings rate could stay elevated, but you still have a lot of excess saving that can come back to support spending over the next 4 to 8 quarters. So I'm not sure it's one or the other. I kind of think both are at play.
Where do you think the crowd is right now on what expectations look like this year? I'm looking at the Bloomberg, and in our survey, we've still got the estimate for 21 at 5.6%, the median view of the economists that we survey. The Fed's at 6.5%. I know you're pretty high up as well, Mike. Where do you think the crowd is now?
I mean, so on a Q4 basis, I'm at 7-8. I think a lot of these aid bills are spent out in about 4 to 6 quarters. So we're expecting a lot of this to come back. I think the momentum will still be to bringing these forecasts higher, given the data that we think is about to be hitting the economy in the second or third quarter, with the second quarter being the effect of the rebate checks that are already in accounts of households. And then Q3, where your previous guest was saying airlines are about to open up both domestic and perhaps later this year international travel. I think the third quarter is more about kind of unlocking some of the pandemic effects. So we think the next 2 quarters are going to be quite robust.
You mentioned 7 or 8, and we've had this all this week, Michael, and this is with great respect to your ability to play the game. Do you have a whisper number or a tilt? Is your tendency to 7 and below, or do you really want to go out over 8% if you get the number wrong?
I mean, I'll go where the data says. So if 7/8's wrong and it should be 8.5, we'll be going in that direction. I think what I would say is we've put about 80% of the stimulus bill in the first 4 quarters. So there's not a lot more that my forecast can go up. I fear there could be, delays or things that push it out into 2022. I'm not sure all that matters. I think the qualitative story is still one of a very strong recovery, and where it falls in each individual quarter is more of an economist game. I'm not sure that matters for anyone else.
John, that thud you heard was Jeff Staley falling off his chair in London. Gaping's going out over 8%. Staley was like,
this
whoa.
Deceleration story, though, is important, Tom. 8, that catches your eye.
It's an excellent point, because if we're right that it's a very near-term burst, you do get a fairly sizable softening in growth next year, just on the mechanical fading of
Give me a number for 22. Let's have the number for 22. The Fed's at 6.5 this year, 3.3 next.
Yeah, I mean, our Q4 on Q4 is 1.2. Our calendar year average number is 4. So that would be a pretty dramatic slowing.
A big one. Michael Gapin, Barclays head of U.S. Economics Research. Mike, good to see you. Thank you.
You have Purdue in the bracket, Michael? Oh, he left.
He left. I thought you were talking to me. I was going to say, of course
John,
I do.
Purdue, Indiana University. It's like Cambridge.
Michael Gapin's back. He's come back just to answer the question.
Back? Good. So I would definitely go Indiana, but also my mother went to Loyola, and I played in high school against Porter Mosier. So this year I'm a Rambler.
Okay, you're a Rambler.
That was foreign to me. Does anyone want to translate
that?
John.
Me too. That was foreign to me.
Michael, thank you. Michael Gapin.
Thank you.
Can you translate, Tom? You can't.
No,
either.
I can't translate.
What's a Rambler?
I don't know. I'm just trying to figure out where Gonzaga is on the map.
I think it's on the West Coast, isn't it? I was told yesterday. I've got a lot of people that went to Gonzaga email me yesterday after I said I never hear of them once a year.
I do not make this up. And John knows this because he's done it too. Richard Truman produces me on radio. He's the only one I'll work with. And John, when I'm doing sports with Michael Barr, Truman is in my ear telling the robot what to do.
Jamie Berlin does that for me on TV, Tom. The disadvantage we have right now is that you don't have Richard Truman with you right now, and I don't have Jamie Berlin in my ear.
We did it on Michigan basketball yesterday. Rich Truman saved me on Michigan Go Blue basketball yesterday.
I'll keep my fingers crossed. I know you like the color blue, Tom. And that's basically it for the brackets. We'll talk markets. Don't worry about that in just a moment with Mohammed Al-Arian, Bloomberg opinion columnist and Queen's College president.
Green.
I'll ask him.
He's got the Jets in his bracket.
I'll see what he's got to say.
Yeah.
We get a viewer writing in saying rambles all the way. No idea. We'll talk EM and the bond market a little bit later. I won't be talking basketball and brackets. I've got nothing to add there. From New York City this morning, good morning.
Cambridge should make the bracket.
We'll ask him if Queen's College can play basketball. What a week it's been, Tom. Take a breath, take
I think
a
I'm going
moment.
to take next week off.
Honestly, I think you are off next week, aren't you?
Better bet so.
You're taking 5 days off.
I'm going to go
get a phoner?
I'm going to go hang with Tyler, the Creator.
Okay, whatever that means. Have fun. I look forward to that. Lisa's back on Monday from New York City this morning. Good morning. Alongside Lisa Abravitz on Monday. I'm looking forward to that with Tom Keane this morning. Tom's going to stick with you through radio into the next hour as well. In your equity market, we're higher by 11 points. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. Russia's Vladimir Putin is still hoping to have a public conversation with Joe Biden to clear the air between the two presidents. That's according to a Kremlin spokesman. Earlier this week, President Biden accused Putin of being a killer. Moscow responded by recalling its ambassador from Washington. That's a traditional way countries have of showing their displeasure. In Alaska, the first high-level talks between the Biden administration and China turned tough almost immediately. Secretary of State Antony Blinken raised concerns about cyber attacks, the treatment of Muslim minorities, and Beijing's control over Hong Kong. Chinese officials criticized the U.S. over the killing of Black Americans and called the U.S. the champion of cyber attacks. The UK is edging closer to a limited Brexit financial regulation deal with the European Union. It's a step that could help give firms in the City of London more access to the single market. Bloomberg's learned the EU could grant the UK so-called partial regulatory equivalence for some financial products. It's a sign of just how hot the US housing market is now. There are more than 60 banks and other firms financing house flippers today, according to investment firm AlphaFlow. That's an increase of almost 50% in a little more than 2 months. Profits on flip are at a record high, about $66,000 on average. In China, the military has banned Tesla cars from housing complexes and other facilities. Bloomberg's learned there are concerns about sensitive data being collected by cameras built into the electric vehicles. Tesla uses several small cameras to help guide parking, autopilot, and self-driving functions. Global news 24 hours a day on air and on Bloomberg Quick Take. Powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
I've noticed that the tone has changed. People seem a little happier. There's a little more buoyancy. I actually expect by December, and this is, again, if these variants are under control, people are vaccinated, I think we're going to have one heck of a December. There's a lot of pent-up demand, a lot of pent-up money, both on the consumer side and on the business side.
really good interview there with Thomas Colicchio. He is a restaurateur. You know him from Acclaim on television, and he crafts the restaurant craft. The good news for him is he opened up Los Angeles in this week, and he saw a buzz in New York. We continue our Bloomberg surveillance discussions on New York City, and really with a national cast, the mayoral race here, with many, many candidates. What's interesting here is I want you to imagine for a moment living 2 blocks from where you grew up. How many of us in America today can say that? And far more importantly, to have a candidate come on who we could interview on national economics. Out of Stuyvesant and the acclaimed economics program at Wisconsin-Madison, Catherine Garcia joins us. Catherine, thrilled to have you on today. You're one of the few candidates who has in the trenches operational skill on running New York City. This in our environment and this in sanitation. What do you bring to the table because you've been in the daily trenches of operating this great city?
Yes, no, so I've been a public servant for the last 14 years, and you got to know how to pull the levers and turn the dials. It's a big city. There's a lot going on, and it's a lot of logistics. But we also know that we need to get this economy back up and running.
Well, within getting it up and running, there is the question of budgets and budget overlays. You've had some real arguments with the present mayor about budget cuts and that. How do you expect to get the dynamism going again within the fiscal realities of any great city?
Oh, there is a lot that as mayor I can do to make it so that we are helping businesses that really bring back the dynamism that we need to see in the city, and also our arts and culture. But we also know that we have to deliver critical city services. We have to make sure you have drinking water in the morning. We have to make sure the city's clean, and you have to make sure that people feel safe, because if they don't come back. And these are lessons we learned in the 1970s.
You've learned them across decades of work here, particularly in sanitation. Help me with the subway system. Maybe you're removed from what Pat Foy's doing and others, but take what you learned in sanitation and bring it over to the biggest headache in New York, the subway system.
Oh, no, the subway is our lifeblood. For any New Yorker, you got to get on the subway. It makes it so we have a much more dynamic labor market. But sometimes it's the things you don't see that are the most important, and focusing on ensuring that your signals are up to date, working really closely with labor to make sure you're doing things in the most efficient way possible, because we need a functioning subway system, but we've got to do it effectively and efficiently.
How will you speak to the labor known as the police? There's a great debate in New York City. We've had other candidates come on who lead with their relationship with our law enforcement. How will you, coming from a different perspective, deal and work day to day with our police force?
Right. The police force is a uniform force. I'm the only person who's ever run a uniform agency. You might not think of sanitation that way, but a lot of how you manage this type of force is the same. And you can get real culture change if you are measuring the things that you want. If you want community interactions and you promote off of that, it sends a huge message through the force.
How do you tie the boroughs together? The heart of the matter of modern politics, and we should point out, folks, a former mayor has a nodding acquaintance with his television network and radio network. But how do you, Catherine, how do you pull together these disparate boroughs, their income and economic inequalities?
Right, but there's so many things that are actually similar about us. New Yorkers want their government to work hard for them. And they want to make sure they're getting value for their tax dollar. They want to make sure their kids are going to great schools. This is what I see when I go to different places in all of the boroughs having the same conversation. How are you going to take care of the city? How are you going to make sure that I have opportunity? How are you going to make sure that my kids have opportunity? And keep it clean, plow my snow, keep me safe.
Catherine, one final question, and it's a really important one as well, and I don't mean to make light of it, but it's a huge issue. How are we doing on recycling? There's a whole school of thought that we recycle and it sort of goes out there and it just sort of disappears and nobody really knows what to do with it. Is our recycling an effective program?
Oh, absolutely. And ours is a little bit different than the rest of the country because we still keep our material separate. But I'll tell you that if you live in Manhattan, all of your paper is going to Staten Island and being made into a new box on Staten Island. And for metal, glass, and plastic, there are strong markets, as I'm sure you know at Bloomberg, particularly for metal and certain of our plastics.
Okay, I got one final question, Catherine. What do you need to do before this contest? What are you going to do in campaigning out?
Oh, no, it is really about getting my name out there. The message is resonating. So that is boots on the ground, canvassing, talking to voters.
Old style.
Old style. They want you to ask for their vote.
Catherine, thank you so much. Catherine Garcia, of course, her operational expertise was sanitation in New York City, a Democratic candidate for New York City mayor. For those of you across this nation and worldwide, fascinating for New York City, but maybe harkens to some of the tensions we're going to see across the 2022 contest and also into the next presidential election as well. What I want to do right now is set up my weekend reading to get out to the end of this quarter and to get out into whatever's going to come within what is absolutely an original economy. We've heard that this week from all of our guests. The originality here, the boom economy of 7 and 8%, the resiliency of a stock market, futures up 8, Dow futures up 26, and of course the real miracle here of the last 2 months, the VIX from a 31 handle into a 21 handle. What am I going to be looking for? I want to recalibrate on 2 core items in my reading. One is economics, and the other, of course, always goes to the bond market. I'm sure John Farrell will talk about that on the real yield here this afternoon. In the economy, I really have a mystery about the multipliers involved. We're going to get a boom economy that maybe we saw in 47, 48, but anybody watching this and listening to this has never, ever, ever seen. We have no clue what those multipliers look like through consumption, through investment, through government, and decidedly, and I go to Alan Ruskin of Deutsche Bank on this morning, through net exports and imports as well. That's the first mystery I'm going to look at. The other mystery I'm going to look at is in the bond market, and you heard this from Wells Fargo not once but twice this week on this program, which is, what does a bond bear market look like? Price down, yield up. You get 1 month statement, whether retail or institutional. Then you get the 2nd month statement, retail or institutional. And then there's the 3rd month statement, and you say to yourself, wait a minute, this feels like the stock market. When was the last time we experienced that? That'll be some of our questions in the next week as well. Coming up, someone who's really led with a graphical view on this changed economy, Stephen Ratner of Willett Advisors. Balance of Power, 12 noon. Stay with us. This is Bloomberg.
Everybody says we should practice before we go to Mars, but some people say we need to practice on the moon. Well, you could practice on the moon, but you can do it at 1/10,000th the cost in the desert in Utah.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield. From New York City for our audience worldwide, good morning, good morning. The countdown to the open starts right now with equity futures positive on the S&P 500, up 8-9 points. We advanced 0.2%. In the bond market, where all the attention has been over the last several months, your yield 170 almost on a US 10-year. With some breaking news, here's Mike McKee.
Good morning, John. The Federal Reserve is letting the supplementary leverage ratio exemption it granted to banks expire as planned on March 31st. Now, the banks who have over $250 billion in assets must hold 3% of their leverage exposure in Tier 1 capital, which generally means equity. The biggest banks, the G-SIBs, the 8 of those, they have to hold 5%. The leveraged assets are not risk-weighted. They include treasuries and reserves held at the Fed. The rules put in place after the financial crisis to ensure banks would have enough capital to offset potential crisis losses. Now, what happened during the crisis is the government issued billions in pandemic relief checks, and the Treasury Department sold hundreds of billions in bonds to help pay for the relief efforts. Much of the proceeds then end up in banks as deposits, which increase their exposure to the leverage ratio, and they would have to raise the capital that they held, whether they wanted to or not. So last April, the Fed exempted the Treasury holdings and reserves, essentially cash, from the requirements, the calculation, because they were afraid that banks would pull back on lending because they didn't want to have to set aside more capital, or they wouldn't have enough capital. In other words, be able to expand their balance sheet. Now, Fed officials have told us this morning bank balance sheets are in good shape. They have more capital than exposure right now, and so therefore they think they can go back to the status quo before COVID. However, reserves have grown so much bigger than the Fed anticipated when they passed the exemption last year. They estimate banks have they thought banks would have 1.3 trillion in reserves now. Instead, they have 3.5 trillion. So there's a question about whether the banks would stop taking deposits or stop buying as many treasuries. The fear is that would send cash into the money markets, and that would affect repo rates and increase volatility. The Treasury is, the Fed rather, is going to consider changes to the way the ratio is applied, although they say they will not lower the levels because they figure with more reserves coming all the time, the banks are still going to have this issue of expanding their balance sheets hanging over them for some time.
So, Mike, let's turn to the price action briefly, and then we'll follow up with a couple of questions. Your yield is higher by a basis point or so on a 10-year. It was lower on the session by 1 or 2 coming into this decision, 172 on 10s. The equity markets rolled over a little bit, but then snapped back. And you've got to think about this in a clear head. You've got the psychological knee-jerk reaction, which we don't have much of one right now. And then just looking at where ratios are at the moment, as I understand it, banks have cushions over the SLR requirement, even with or without this exemption, Mike. So this whole conversation about banks needing to dump treasuries and all of this kind of talk, where is it in practice?
It appears that over the last week or so, thinking in the markets adjusted on that. Now, banks sold off about 80 billion in treasuries over the last couple of weeks. Some people think because they were trying to prepare for this, and others say that the banks, because they had a larger cushion as it were, they did not have to dump treasuries and would not affect the money markets as much as anticipated. But some of the people who had the biggest fears have switched their view in the last week, thinking that they could get through this. The question is now going to be longer term. What does it mean?
Is there a contradiction here in the approach of the Fed, what they're doing with monetary policy and what they're doing with regulation simultaneously, Mike?
Well, there could have been, because what might have happened in the repo market is rates might have gone up. If a lot of cash went into the money markets, that would push down prices for repo and raise rates, and that would raise rates in the lower end and perhaps push up the Fed's rate. And so the Fed didn't want that to happen. But essentially, they put in place a precautionary measure a year ago, and now they've decided they don't need it any longer. It could be a problem down the road, so they're going to look at what might need to be done, but at the moment, they think the markets can survive this and rates won't rise.
Mike, stay close. Let's get the price action. Here's Kelly Lydes.
Well, John, the Treasury market doesn't seem too concerned about the prospect of banks having to offload some of their treasuries. We did see that knee-jerk slight spike up in yields only by about 2 basis points or so, and right now we're basically flat on the 10-year Treasury, sitting right around 1.71%, not even a basis point move at this point. But we know that banks had been pushing for an extension of this, John. They, of course, didn't get one. JP Morgan had warned it might have to shun customer deposits if tougher rules were reinstated, and that stock, the underperformer at the moment, down 1.4% in pre-market trading. Bank of America, also very consumer-facing, is down by about 1.2%. Citigroup down by about 0.7. So we will continue to monitor those bank stocks, John.
Kelly, thank you. Let's get some reaction for you from Priya Misra of TD Securities. She joins us on the phone, just quickly dropping by on this breaking news. Priya, just your reaction initially to the decision by the Federal Reserve this morning.
I think it's a mistake because the Fed is doing QE. They're inserting reserves into the banking system, and these reserves have to be held at banks. So now banks have to hold more capital against it. I mean, it's certainly negative for banks, but as a Treasury analyst, when I think about Treasury market functioning, SLR is a large reason why the Treasury market functioning broke down in March of last year. I mean, beyond all the demand for liquidity, dealers were not able to intermediate. And so I think this is going to reduce the ability for dealers to intermediate in any shocks. Now, they have left the door open. They want comments. I think if the market breaks down again, if you get another stress point, there may be a relief coming later. I think they want to work on longer-term issues with SLR. But
yeah,
I think we've got Treasury auctions next week, and banks are not going to be in there buying. And I think that's what's going to create the stress point around auctions. We've talked about that in the past. I think we just see every auction becomes a bigger stress point for the market because the Treasury is selling a lot of Treasuries that we need to find a buyer for.
Priya, let's build on that just a little bit more. We get $62 billion of 7-year notes, I believe, on March 25th. So we're doing that story again. When it comes to stress points, is that the focus for you then? Is supply? That's where this could show up, the supply and the ability to draw down that supply next week.
Right, because primary dealer inventories are counted in the bank holdings. And I think it's the quarter-end auctions that are going to be harder. Because on a daily basis, you know, the banks may be able to intermediate. But when you're right at the end of the quarter, when you have a reporting date, those auctions become more difficult. And then we're going to need foreign investors in. We'll need, mutual funds coming in at a time when interest rates are rising and bond outflows are a risk. I'm very nervous about next week's auctions. I mean, at some price, they'll get taken down. It's just, do we get market functioning issues? And I think, the Fed has a backstop there. If it is, complete mayhem at an auction, I think we do expect the New York Fed to step in. But it's just, I don't think the market was ready for this big relief to be removed. So I guess now we're just going to see more volatility in the rates market going forward.
Hey, Priya, I know you've got to get to clients, so thanks for your time. And thanks for jumping on the phone. Priya Misra there of TD, Priya Misra, joining us on that breaking news. Mike, just a final word on all of this. We're talking about the potential complications, the outcomes, the stress points, maybe showing up in supply next week. What's the focus for you? Because right now, this Treasury market is taking things in its stride for now.
Well, that's the question, John, is what's the longer-term impact, particularly in the money markets and particularly in the repo markets? Do we see rates go up? This should push rates higher to a certain extent. There was a fear last week that rates could drop and perhaps pull the Fed funds rate low to 0 or even below. The Fed last week enabled more dealers to enable more overnight repo, doubling the amount that they could put up. And the market seems to think that will help in the short run.
Mike, thank you. Stay close. We'll keep on top of this story. I want to bring in Mohammed Al-Erian now of Bloomberg Opinion and, of course, Queen's College President, patiently waiting by. Mohammed, you've been listening to this conversation. Your reaction this morning, please.
So now we understand why Chair Powell wanted to separate the SLR decision from the monetary policy decision, because they could have been viewed as contradictory. I don't think they are, but I listened carefully to what Priya said. John, I think the bigger issue here is that the economic paradigm is changing, and the Fed doesn't want to change too much the policy paradigm. So while this is a change, it's such a small change, the bigger issues remain. And the reason why is because it doesn't want to disrupt the liquidity paradigm. So when we look forward, whether it's end of quarter or beyond, the question is, how do you reconcile the economic paradigm changes with policy and liquidity? And that's what the market is trying to figure out right now.
Mohammed, when you refer to the liquidity paradigm, can you tell us in more detail what you are referring to and the reason you're so concerned about it at the moment?
It's what you said earlier today when you were on with Tom, which is, have you noticed that good news for the economy has turned out to be bad news for the markets? And it's a complete reverse of last year. And what reconciles all this is that bad news for the economy meant ample and predictable liquidity injections by central banks around the world. Now we're seeing increased dispersion among central banks around the world. And that is undermining what has been a very comforting liquidity paradigm. So that's why you've noticed, and others have noticed, that good economic news has become bad news for markets. And the transmission mechanism is the liquidity paradigm. There's less confidence in the robustness of a liquidity paradigm that has been incredibly helpful for assets.
Just how cornered are central banks right now, Mohammed? We've seen the move from Brazil, Turkey this week, Russia, maybe more to come from the Russian central bank, and a Fed just willing to stay on hold, even with the numbers they're forecasting into 2023, a Fed that is willing just to look through it, sit tight, and not do anything with interest rates.
Yeah, I mean, it's going to be harder to sustain. They're not going to be able to sustain that position. I think that even at 6.5%, they are still not incorporating fully the bounce we're going to get in this economy as long as we don't mess up with the COVID battle. So I'm looking at 7% plus for growth this year. It is an open question whether inflation will indeed be transitory, but I understand why they are hesitant to change their forward guidance. So I think they're going to be at some point find themselves in an even tougher corner. And the hope we all have, John, and it's a really important hope, is that we get a second pro-recovery fiscal package that allows for that handoff that we've been waiting for such a long time from excessive reliance on unconventional monetary policies.
In the meantime, we've had to deal with a lot of volatility in this bond market, a big drawdown in treasuries, a big surge in treasury yields. Mohammed, you've seen treasury sell-offs a million times over several decades, and we've got the benefit of leaning on your experience right now. How unique has this sell-off been? How unique is this moment for you?
So, John, what's encouraging about this moment is that it hasn't broken anything. If I had told you at the beginning of the year that we're going to get a 70 basis points move within the first 2+ months of the year, we would have had a discussion about that's going to catch people off sides. Well, it turned out that very few people got caught off sides. And that I think is reassuring in terms of the functioning of the market. Having said that, there were 2 episodes of illiquidity in the midst of liquidity. And that's one thing that concerns me. But it is unique because of the overall environment. But thank God it's not unique in terms of creating breakage in markets.
Well, I know you've been more concerned about financial stability than you have inflation, when others have been focused on that. You said nothing's broken. Mohammed, I just wonder whether we're starting to see cracks leading to something breaking in emerging markets. I'll spend a bit more time talking about that through the program. What's your response been to what's been happening, developing in EM, and what's the team at Gramercy got to say about it?
So I can't speak on behalf of the team of Gramercy. Robert would be much better placed. But the message, I think, that is consistent with what they're thinking is the following, is that it's very hard to make a case for EM in general. But you can make a case for being long or short different names. EM is very diverse right now, and you can no longer rely on liquidity just going there. It is going to be a very selective year for emerging markets, and it will be for risk assets as well. look at what's happened so far this year. As of yesterday, banks were outpacing the NASDAQ by 30 percentage points. So the market is starting to figure out that the liquidity paradigm, if it reverses, will hurt certain segments more than others. And I think the market is seeing its way through it, but it's going to be a very differentiated marketplace.
Mohammed, it's always great to catch up with you. We're lucky to have you on to respond to that breaking news. Mohammed Al-Arian, send our best to the team at Gramercy as well on the emerging market story, and hopefully we can catch up with them soon too. Mohammed Al-Arian there, the president of Queen's College, Cambridge. Coming up on this program, we'll talk emerging markets and China. The Biden administration and its first high-level meeting with Chinese officials. It's fair to say getting off to a rocky start. Looking forward to catching up with Kevin Cirilli and a master of EM, Dana Ramoa of JP Morgan Asset Management. This is Bloomberg.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Start your mornings with Bloomberg Surveillance. Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Extraordinary market day.
This rally just keeps on going.
But there is a tipping point.
The business team you love to watch. Weekday mornings on Bloomberg Television.
Our administration is committed to leading with diplomacy, to advance the interests of the United States, and to strengthen the rules-based international order. That system is not an abstraction. It helps countries resolve differences peacefully, coordinate multilateral efforts effectively, and participate in global commerce with the assurance that everyone is following the same rules.
What a moment in Alaska. The Biden administration taking a tough stance in its first meeting with Chinese officials. China pushing back, responding in kind and saying the following: we believe that it's important for the United States to change its own image and to stop advancing its own democracy in the rest of the world. Many people within the United States actually have little confidence in the democracy of the United States. Joining us now is Chief Washington Correspondent Kevin Cirilli. What a moment, Kevin, and largely unexpected by a lot of people.
A shift in tone, maybe not as much as we were expecting, because it was a definite hardline approach from Secretary of State Tony Blinken in his first meeting face-to-face with Chinese counterparts. Now, from here, the biggest question remains whether or not China and the United States will be able to address the plethora of issues that the United States has raised against the Communist Party of China. Let's just take a look at some of the list there, from human rights abuses to Hong Kong, as well as to cyber attacks. Meanwhile, you also have the Xinjiang province, which has emerged as a crucial economic supply chain geographical region for polysilicon, one of the top metals that is utilized in creating solar panels. I raise this point because the Communist Party of China, Jonathan, would like to have some type of virtual interaction between Xi and President Joe Biden on April 22nd, Earth Day. Xinjiang province, Uyghur minority abuses, now coming to a head-to-head battle, really, in terms of all of these types of negotiations.
Not looking pretty, that approach, and foreign policy has been really icy the last couple of days between the US, Russia, the US, China. Let's talk about the lack of an icy relationship right now, Kevin, between the Federal Reserve and maybe Senator Warren and Congresswoman Maxine Waters, too. Did they just get what they wanted about 15 minutes ago from the Fed?
I think, yes, and even taking it one step further, I would note that while they might be able to interpret it as saying that they got what they wanted, Republicans are going to suggest that if there's good news for the economy, then that would suggest that maybe it's bad news for more government spending, trillions of dollars worth of more government spending. So I think, yes, there's something to be interpreted for the far left to agree with. But I also think that you're going to hear Republicans maybe start to use this as evidence that it's time to stop so much government spending.
Senator Warren wanted that exemption to expire, and the Fed announced relief from the supplementary leverage ratio will expire at the end of this month. That news coming out 20 minutes ago. Hey, Kev, good to catch up. Busy weekend for you, I know. Kevin's already down in Washington, D.C. Dana Ramoa of JP Morgan Asset Management joins us now for more. Dana, we need to talk about China. It was a key risk for you, for EM, that maybe things could break down between China and the United States. What was your reaction after the events yesterday?
Well, that's just the opening shot, right? Each side has to start this conversation very strong and actually focusing on their key areas of contention. I think the fact that both sides were meeting, it was fairly high-level representatives of both parties, means that there is a willingness to try and find the rules of engagement going forward. But I think first what we've seen is they've agreed on the areas of disagreement. And as talks progress, I would expect there to be a little bit more willingness to focus on areas where they do see eye to eye. So things around climate change, nuclear policy, COVID response. So that's the expectation, that we've seen now what the sticking points are, and going forward we might see where the middle ground is.
Starting to see cracks, though, in the broader emerging market story, and if it's not driven by the China conversation, it's certainly driven by the rate story in America. To see Brazil hike the way they did earlier this week, Diana, Turkey to follow, Russia to talk about doing more as well. What's been your response? What have you done just in terms of allocation to EM this year, and has it changed in the last month?
So we had a very bullish view on emerging markets for the second half of last year. At the start of this year, lightened up a little bit just on valuations concerns more than anything. But we still remain constructive of EM, and actually we see this recent backup in rates as an opportunity to reload EM exposures. What you have seen from a policy response is actually what we were hoping to see, that the most vulnerable emerging market economies responded well ahead of the curve to reassure markets that they wouldn't be caught sleeping behind the wheel, like what happened when we had the taper tantrum. So it's happening, and it's not actually necessarily surprising that it's Brazil, Turkey, and Russia that are the first ones to go. Brazil and Turkey have huge economic imbalances, and they need to provide an incentive for investors to invest. Russia has huge geopolitical tail risks in the horizon.
Diana, when you say reload where within emerging markets at the moment?
So we're looking at EM corporates. That's the one space that's actually remained quite resilient. We like the story there from an earnings perspective. Leverage levels in EM corporates remain relatively low. And what we're seeing on the ground in as far as reopening of economies should be supportive of that space going forward. It's a low duration sector. So it's more of a carry sector where you buy and hold on improving fundamentals. We're still looking at areas in EM high yield. So again, lower duration, both in sovereign markets and in specific pockets in local markets. In local, we're looking more in the frontier space. But again, we think this is an area where spreads are still closer to where we were at taper tantrum.
Yeah.
So you still have enough valuation, but you don't have that duration sensitivity that's been hurting fixed income markets lately.
Just quickly then, the shorter duration in EM corporates at the moment, Diana, a buy and a hold. What's a buy and hold for you? What's the time horizon?
A buy and hold for us is anywhere from 12 months to 18, 24 months.
Diana Ramoa, going through emerging markets, a really dicey couple of weeks, dicey couple of months. Diana, great to see you. Thanks for being with us. Always good to catch up. Diana Ramoa there of JP Morgan Asset Management. Coming up, the analyst action you need to know. That'll be next in our morning calls. Then later, the volatility in bond markets maintaining a strong influence on equities. That conversation still ahead with Aframiga's Peter Giacchini from New York City this morning. Good morning to you all. Equities unchanged on the S&P, up about a point. This is Bloomberg. Five minutes from the opening bell, equity futures on the S&P 500 unchanged going into the cash open. We're down a couple of points after being up about a point about 5 minutes ago. Let's get you some morning calls, a look at some of the analyst recommendations this morning. We begin first up with JP Morgan downgrading Molson Coors to underweight. The analysts expecting operational headwinds in the US and prolonged European lockdowns to weigh on near-term earnings growth. Your second call from Barclays upgrading Ford to overweight with a street high $16 price target. The analyst expecting the car maker to ramp up EV production after forming a partnership with Volkswagen. And finally, Wedbush upgrading Starbucks to outperform, 124 price target. The analyst seeing significant upside to consensus earnings estimates fueled by a faster than anticipated US recovery. That stock is up 0.9%. Up next, Aframiga's Peter Giacchini warning if the Fed doesn't act, high yields will derail the risk assets in the same way they did back in 2018.
generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Trading revenues coming in better than expected. Everything. Cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
25 seconds away from the opening bell in New York City. Equity futures totally unchanged. Really choppy week. On the S&P 500, down about 0.7%. The Nasdaq got absolutely hammered yesterday. It's negative 0.4% on the Russell. We're unchanged on the Nasdaq. On the S&P, we're not doing much either. The opening bell's about to ring, so switch up the board. We look like this on a 10-year Treasury. There is your opening bell. 174.42. There's your move, up 3 or 4 basis points. In the FX market, Euro back with a 118 handle, 118.82, and crude creamed yesterday, down 7 percentage points. On what? Let's talk about that in a moment. South of 60, 59.85, and down another 0.25%. That's the cross-asset story this Friday. At the market desk with your movers, here's Abby.
John, let's start out with the macro picture. And that, of course, is big tech, because yesterday that NASDAQ getting slaughtered, many of those big names down more than 3% on the day. Right now, not really the bounce back that you want to see, in particular with Apple just flat. Earlier in the pre-market, this stock had been higher. You can see some gains for the like of Amazon, Facebook, Google. But again, after the big decline yesterday, you'd probably want to see something stronger. So let's see where this goes. As for 2 earnings movers, we have a mixed picture here. Nike is down almost 3%. This on a disappointing quarter relative to revenues. They had supply chain issues. FedEx, on the other hand, a strong quarter. They also boosted the outlook as package volumes continue to surge. The street very bullish. And then ending macro, the board I know you want to see, John. Take a look at these big banks really getting hit this morning. They had been flat ahead of that 9 a.m. Fed decision announcement on the SLR. Folks really selling these banks after the Fed is letting that supplementary leverage ratio program expire on March 31st. So that capital help, banks not liking the fact, investors not liking the fact that that's happening, John, clearly with those slides in big banks.
Abby, thank you. On the S&P 500, then slightly negative, but as Abby indicates, the financials down by more than 1 full percentage point. It's a technical issue that we'll try and talk about in plain English, and it's one of those mornings where we're really lucky to have Michael McKee with us to run through things. Mike, walk us through what the Fed has done, or rather hasn't done, in the last 30 minutes, and the implications it could have for some of the banks on Wall Street.
Well, basically, John, a year ago, the Fed gave the big banks a regulatory break. They are required to hold capital, obviously, against losses. And the supplementary leverage ratio that Abby was talking about measures total capital. It includes treasury holdings, and it includes basically cash reserves that banks park at the Fed, even though they are risk-free. And because the government's been selling so many treasuries, and there's a lot more deposits as the government sends out cash, the bank's assets have grown, and their exposure to the leverage ratio grew. And the fear was that they would stop making loans because they wouldn't have enough room on their balance sheet. So the Fed gave them an exception a year ago. Now the Fed thinks they have enough room on the balance sheet. Loan growth wasn't as big as anticipated, and so they can let this exemption expire.
Senator Warren's argument is a pretty simple one. We can't offer these banks regulatory relief if they're going to go out and do the capital returns, capital distribution plans that they've executed with buybacks, etc., over the last several years. That's her basic beginning point. Then she goes through things and basically says, if they can't take the deposits, Mike, if they can't make the loans, guess who'll take the deposits? The regional banks. What's the big problem here? What is the problem, do you think, Mike, more broadly? What do you think the politicians might be missing?
Well, the regional banks would absorb what they could, but they eventually would run up against these limits as well. The real fear was the money would go into money markets, and those are less regulated, plus the fact that all that cash flowing in, money markets have to use it. They have to basically lend it out, and so repo rates would rise. that's the problem that was seen, and there would be a lot of volatility in the markets. But basically, Elizabeth Warren and Sherrod Brown said, if you've got the money to give out dividends and to buy back stock, you've got the money to be able to hold as capital, and we don't want it to the capital levels to go down. We put these in place to keep the banks safe. Now, the Fed says, as reserves continue to grow, as we fund that $1.9 trillion relief package, this will become more of a problem. And so they're going to look at ways to give the banks some relief, but they are not going to lower capital requirements.
So Treasury yields now are higher by 3 basis points, and I imagine if we finish much higher, everyone will draw a line back to the decision that was made 34 minutes ago, Mike. But there is a quote that I think brings some people in fixed income a bit of comfort about what's happened this morning, and I'm going to deliver it to our audience. It's in the press release where they say, because of recent growth in the supply of central bank reserves and the issuance of Treasury securities, the board may need to address the current design and calibration of the SLR over time to prevent strains from developing. Mike, it just indicates the Fed's not done here. Do you get that indication, that feeling as well?
They're definitely not done here. This is all wrapped into the Fed's examination of what happened last March in the Treasury markets when things went really south as the COVID lockdown began. And the Treasury market, according to one Treasury official, or one Fed official I spoke with today, said that the Treasury market was not as resilient as we thought it should be under these circumstances. So they're looking at ways they can make the market work better and ensure these things don't happen again. So they will be coming back to this, especially as I say, as reserves continue to grow and as the danger from this continues to maybe get more real.
Mike, thank you. What a morning. 5 minutes into the session. Let's work through this together. So the equity market's down a little more than 0.1% on the S&P. The financials underperformed, down by 1.5%, as the big banks on Wall Street lose a little bit of regulatory relief. The move in the bond market, slightly delayed. It comes through, though. Yields are up by 3 basis points to 174. For the broader equity market, though, we're not seeing massive moves. For credit spreads, we're not seeing things gap wider. Certainly haven't seen that over the last several months. What happens when you start to get that move through 2%? I think that's where this conversation now is gravitated to in the bond market. At 174 at the moment, if we're 25 basis points north of that, what does this market look like? Here's the take from Alpha Amiga's Peter Cicchini. He writes the following: a move above 2% probably shakes equities, especially given how rich they are already. The 2018 analog might also show that once the reaction happens, it happens fast. The other big difference now is that the Fed has no room to cut, a very big difference relative to upside for risk assets. Pete joins us now for more. Pete, why do you think the 2018 parallel is a decent one in this environment?
Well, obviously the absolute, and hello, John, the absolute level of 10-year yields is obviously quite a bit lower now. And if you recall what happened in 2018, we marched up to about 3%. And the reason I think 2% to 2.5% may be the level this time is because when you look at the progression of 10-year yields going back to the mid-90s, you can, and you do a little bit of math around that, and you regress those yields, and you look at what a 2 standard deviation move is to those yields over that time horizon. 2 to 2.5% is more or less the equivalent of what 3 to 3.5 or 3 to 3.25 was back in 2018. And I think the other similarity with 18 was the communication. Chairman Powell, if you remember, in a presser in December of 2018, was somewhat stubborn in his communication about the pace of the normalization of policy, both from a rate standpoint as well as from a balance sheet standpoint. And the market reacted to that. And I felt some similar sort of undertones, if you will, in the most recent presser where, he said, we're not going to do twist when he was pressed. And of course, he caveated that by saying we certainly can, but the message has been clear. They're comfortable with the pace of purchases at about $120 billion a month.
Peter, try and stay open-minded about a lot of things, because I think myself, like many, have found the last 12 months really humbling. But a key difference for me that sticks out between now and late 2018, the conversation in Q4 2018, particularly going into the back end, was about where the neutral rate was, and a chairman who seemed to think that we weren't there yet, in fact, might have been a long way from it. And there was a real conversation, at least in market participants within markets, about whether monetary policy was simply too tight. Is it difficult to make the argument that monetary policy is too tight when we're about to see 6-7% GDP growth in America and rates that aren't going to go anywhere?
Yeah, look, the causality for the rise in rates, so the analogy breaks down to some extent from that standpoint. That was a balance sheet normalization and rate hikes that made that happen. In this case, it's a number of other things. It's Treasury supply. The Fed is now, one of the largest participants in the Treasury market. There are others certainly, but the duration transformation that it undertakes when it does QE is absolutely critical to the fact to keeping the Treasury markets clearing on a regular basis. We're going to have, again, about, let's call it 1.5 trillion of Fed purchases versus deficits that are going to be for 2021 somewhere between 3 and 4 trillion, which means that other market participants are going to want to step up to make up for that. And actually, that's where the SLR comes in to some extent, because anything that chills the desire for market participants to own treasuries, I think, is somewhat problematic.
Well, Priya Misra indicated she was worried about that 7-year supply that was coming next week, and we'll see what that looks like when it comes to market next week, Peter. I want to talk about fixed income, high yield, credit more broadly. That December comparison, we saw high yield spreads blow out 100 basis points, bang, just like that. I remember the primary market, we didn't see a single issue from US high yield for the whole month of December. Some of these issues were truly unprecedented, Peter, in many ways outside of crisis times. Are you expecting to see that kind of story roll out? I'm always trying to understand when people say there's a risk, when we go through 2%, and they use dramatic words, and I'm not implying that you have, but others do. I'm trying to understand what that actually looks like in the market, Pete. What are you expecting to happen?
Well, the reaction functions are critical here, okay? And if we see yields rise above 2% to let's call it 2.5%, what the Fed does, it obviously learns from missteps heuristically. If it steps up the pace of its purchases, that will certainly help, and perhaps they'll get ahead of any sell-off in risk assets. If 2018 is any guide, what then happened after we got the equity market sell-off and the blowout in high-yield spreads was yields came in, right? That's the market reaction function to what happened in long yields. And then that helped to stabilize both credit spreads as well as equity markets. So I would expect something of a credit widening, or of a spread widening, pardon me, but more importantly, I think, to the high yield market is really what happens with default rates in 2021, and even with a pickup in GDP, which I expect just like everyone else, maybe at 6%, 7%. It's really guesswork for everyone here.
Yep.
What happens with corporate earnings and cash flows actually could be something of a very different story, because the stimulus is somewhat the stimulus is inorganic. So I'm concerned when the stimulus wears off that the default picture will actually be somewhat worse than people are anticipating.
We'll have that conversation with Jim Keenan of BlackRock. Pete, it's always good to catch up. Peter Cicchini of Alpha Omega there on this market and the risks that lie ahead, potentially. Your Nasdaq rolls over, it's down about 0.1%. On the S&P 500, a struggle too, as bond yields start to climb a little bit over the last 10 minutes. With your movers at the market desk, here's Abby.
John, let's start out with a story stock board, because we have some of the oncology stocks absolutely soaring. In particular, Clovis Oncology is popping sharply higher. It's best day in almost a year on the news that their phase 3 ovarian cancer trial met the primary endpoint. So that stock is up about 30%. And then you have a few other oncology stocks also trading higher. Technology at this point, last time I looked, is higher. This despite the fact that you now have yields above 170. Yesterday, the technology sector, as you know, could not digest 175. Today, 174 is okay. Well, actually a little bit mixed. And then finally, the banks, as you know, really getting hit on the news that the Fed is removing that capital brake. You see big declines here for the banks on the morning, John.
Usually correlated with yields. Not today. An inverse correlation there, Abby. Thank you. Banks down with yields up. There's one for you. Up next on this program, the number of the week, 2.5 million doses of a vaccine rolled out in America on average every single day over the last 7. And we are well ahead of President Biden's schedule. That conversation coming up next with BlackRock's Jim Keenan from New York. This is Bloomberg.
80% of the world's trade travels by sea. At any given time, around 5,000 ships are on the ocean carrying containers. Without them, the global economy would collapse.
Many of those containers pass through here, Singapore, the world's second largest port. The industry accounts for 7% of the country's GDP.
But the industry is under pressure. The uneven recovery from the pandemic is creating a shortage of containers where they're needed most and driving bottlenecks at major ports. It sent freight prices soaring.
Since the beginning of COVID-19, these are levels of shipments that we've never seen before.
Chinese New Year marks a seasonal turn for freighters when rates are renegotiated for the next year. Companies must choose whether to swallow the financial hit or pass on the cost. It's a decision that could bring new headwinds for the global economic recovery.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
We're way ahead of schedule, but we got a long way to go. 58 days into our administration, we will have met my goal of administering 100 million shots to our fellow Americans.
What an effort over the last year to get that vaccine and then to roll it out and to get the numbers we're looking at right now, 2.5 million a day on average over the last 7 days. For more, I'm pleased to say, waking up a little bit earlier for us. Usually Romaine does that for us, but this morning Taylor Riggs does too. Good morning,
I drew
Taylor.
the short end of the stick, John. And to think a year ago, they told us this was never possible, right? Take a look at the statistics of where we are. 100 million doses in the first 60 days of office. Remember, this was the initial goal to get in the first 90 days of office. So we're getting there about 30 days earlier. As you had mentioned, 2.5 million jobs a day, 75% of the population will be covered in just another 5 months. And we're just fewer than 20% of our total population that will have seen some jobs, 12% of that covered completely with both of those vaccines. Let's take a look, though, what this means for a global perspective. John, if you flip up the board and take a look at the terminal, we're averaging about 5 million jobs a day on a global basis. The latest data, though, the last 7-day average, double that. 10 million jobs a day. I'm looking at term 7006 if they want to change that up. But you'll see just about 410 million doses administered. 30% of the total, though, John, coming here in the U.S. And part of that problem is, if you flip up the board, really the struggles that you've seen within your European Union, for example, not to blame you entirely, but take a look.
Anymore, Taylor.
Take a look at some of the EU nations, of course, that have been suspending that AstraZeneca vaccine. Indonesia, the good news, as they are announcing resumption today. Scandinavian nations, they're holding off a little bit until they get some local health opinions. But German cases, John, by suspending that, those cases rose the most in 2 months. You have the big four, Germany, France, Italy, Spain. They've all covered just about 6% of that population. So really hoping that they start re-upping that AstraZeneca.
Taylor, thank you. Go back to bed, won't you? Taylor Riggs, watch her on the open and on the close a little bit later today. BlackRock's Jim Keenan has something to say about this vaccine rollout to deliver a stronger recovery. He says the following: investors are repositioning for a cyclical recovery as vaccine distribution continues to accelerate. The economy reopens and consumers begin to spend their excess savings. The 10-year yield could rise further over the next 6 to 12 months, especially if growth and jobs data surprises to the upside. Jim, I'm pleased to say, joins us right now. So, Jim, let's start right there where you finished. How on earth can we surprise to the upside, given the forecast that we've seen over the last week? I think there's more to come.
I do, and obviously you've seen the market start to really adjust over the course of the last couple of months to the conviction around that opening. I mean, there's a lot of things that are happening at once, right? I mean, the virus and the impact of the virus is coming down dramatically, and sure, there's variants to deal with, but we have weather turning, we have the stimulus checks going out, you have the confidence and therefore the start of a reopening, and you have all this pent-up demand. that will immediately come back to the market over the next couple of months. And at the same time, the market has been positioned in a different way. So there's lack of inventory relative to that level of demand. And I think as you see that demand come back, you're going to see some extraordinary numbers from growth, demand, inflation in the short term because of the base effect relative to Q2 of last year. And so I think the next couple of weeks are going to be pretty significant with regards to the numbers. But over the course of the next year, there's an enormous amount of tailwinds to have some sustainable growth associated to that. And the markets have to adjust. I mean, they're rebalancing to that level of growth.
Clearly seeing that in the Treasury market. I saw Rick out on Twitter saying a similar thing, Jim, about the surprises we could still see to the upside. So the unfair question to ask the credit guy is, why do I want to be in credit in that environment, Jim, given where we are right now?
Yeah, but I think, what you're looking at really right now is an incredibly strong demand and growth picture in the short term. And obviously, I think there's tailwinds to have pretty significant growth over the next 12 and 24 months. I think, as Rick points out, you're going to see some continued pressure on the curve as adjusting to that level of demand, growth, and inflation. And, when you think about what that means from an earnings perspective, I think the operational leverage, the financial leverage in the system, you think about that level of GDP growth, what that's equating to operational leverage and earnings growth, that's very supportive of credit spreads. I actually think it's supportive of earnings at where they are right now for equities. But when you think about levered credit, bank loans, high yield, they're not going to be big total return plays this year. But from a fixed income perspective, they are more tied towards the health of that corporate earnings and that rebound, and they are more shorter duration, so they won't be as impacted by that yield curve move.
It was unfair because what I was implying, if things are going to be that good, I'd just be better off in equities. But when it comes to managing credit, Jim, we've got to focus on fixed income. So let's sit there for a little bit longer. When you talk about underallocated segments of fixed income right now, some people outside of your world might struggle with that on the outside looking in, given how much we've seen been baked into this market over the last 12 months. Where do you think we still are underallocated in fixed income?
Well, I think it's moving rapidly. Right? I mean, right now, you do see a demand for spread product, really high yield bank loans, globally speaking, because you are seeing a lot of fixed income investors moving into that shorter duration product, and again, one that is more tied towards earnings growth. I think over the course of time, as you see that rebalancing and that move from the yield curve, and as we get further into this recovery, you will see a little bit more balance come back into play, and you'll need to see a rebalance, and you'll start to see investments back into longer duration fixed income product, including rates. Because from a balanced portfolio perspective, if you think about many of our clients, once you start to see that move over 2% on the 10-year, or you see the long end move, it really starts to play as a hedge against their equity portfolio, and a real more balanced and a resilient portfolio. So I do think that will come back into play later this year.
Jim, I think that final point is so important because we're going to start to think about the deceleration from 21 to 22. It comes into sharper focus pretty quickly. Are you and the team at BlackRock considering that a lot more, or is that still something for down the road?
No, I think you have to think about that. Obviously, they're shorter term plays, but when you look at not even 21 to 22, but when you look out to 2023 and beyond, we are still going to have to deal with the fact that fiscal deficits will come in. You will start to see a drag. Some of the savings that you'll see spent from a consumer standpoint in 2021, that will start to come in. So the long-term engine for growth or sustainable inflation is going to be challenged by the aggregate debt and demographics of the world right now. So I think that comes into how you're thinking about your balance between equities and fixed income, longer duration assets, and certainly what you would pay from an equity multiple on earnings growth in the future.
Hey Jim, great to touch base as always. Good to see you, sir. Jim Keenan there of BlackRock. Thanks for your time. Really important conversation, that deceleration from 20 to 21, accelerate 21 to 22. What does that look like? In your equity market right now, down 0.4% on the S&P. Up next, your trading diary. This is Bloomberg.
can somebody remember things that happened 80 years ago? How do you do that?
David, it's easier to remember 80 years ago than what I had for lunch today.
I have asked the Securities and Futures Commission and the Hong Kong EX to work together to explore the viability of our own Hong Kong version of SPACs. We remain very confident on the competitiveness of the Hong Kong stock market.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
"25 minutes into the session, stocks down 0.4% on the S&P. The Nasdaq stable, yield started to push out in the last 30 minutes too. Getting interesting, more interesting than it was about 30 minutes ago. Time now for the training diary. What you need to be watching through the rest of today and into next week. President Biden's stimulus tour continuing with a visit to Georgia later in the day. Then looking ahead to next week, Fed Chair Jay Powell and Secretary Janet Yellen testifying before Congress on Tuesday, Wednesday. Big tech CEOs heading back to Capitol Hill potentially next week too, plus President Biden holding his first formal news conference, and rounding out the week on Friday with US personal income and spending numbers. Rounding out this week with a great lineup on Bloomberg Real Yield later. Francis Donald, Kathy Jones, Robert Tipp, don't miss it. From New York, have a great weekend. This is Bloomberg.
Women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
Months after Hurricane Maria, Puerto Rico is still in peril. Huge swaths of the island are still without power, running water, or access to medical care. Experts estimate that it will take years before these services are restored island-wide. Much of the blame has been placed on FEMA for a slow response in comparison to recent disasters on the mainland. But recovery from a disaster of this complexity and scale has proven more challenging than anyone anticipated. And filling the gaps between an overextended public sector and a suffering populace falls on the private citizens. Robert Anderson is a Puerto Rico resident of 4 years.
The eye of the storm came in south of El Yunque, swept up towards San Juan and out to Arecibo. Everything on the right-hand side is what we call the dirty side of the storm.
This isn't his first time in a disaster zone. With a military and telecom background, Anderson worked on repairing damaged cell phone towers in New Orleans after Hurricane Katrina. Some might be tempted to label him a disaster capitalist, seeking lucrative government contracts for his expertise. But as Anderson finds himself in the middle of a humanitarian crisis, he and his associates are developing a variety of pro bono recovery projects that target the island's hardest hit areas.
I see two Puerto Ricos. We're here in San Juan. They have telecommunications restored. They may or may not have power, but basic services are in place. They're able to get food. They're able to buy things. They're surviving. And when you look outside of the San Juan area, you can go 15 minutes from here and find areas that are devastated. I'm working on the devastated side.
Today, he's put together a boots-on-the-ground mission to provide medical care to some of the island's most isolated and vulnerable residents. Steve Berenbaum is one of Anderson's business associates. He offered an extra car and a set of hands.
So we received an initial report from a nurse that was out in the area. We're headed to the northeast region of Utuado for some people that are in need of urgent medical assistance.
Dr. Sally Priester is a physician from San Juan. She filled a van with medical supplies at her own expense and brought along a team of nurses. Google Maps estimated our first destination to be a 90-minute drive. But it didn't account for obstacles like this. Our first stop was the home of an 82-year-old blind Vietnam veteran. His roof was blown off by the storm, and he's been living alone in a back shed for nearly 2 months.
His cane actually got broken in the storm, so he's limited mobility. He has a number of medical ailments. Dr. Priester's having a look into him. We called the VA. They're going to get him set up with what he needs, get him stabilized so he can then be transported either to an evacuation center or off the island. It's when the chain gets broken, when those families that are connected to them leave the island or take off, these guys get left at the end of the road, and it's tough.
FEMA was not officially part of Robert's team, and their arrival caught everyone by surprise. Their job here was to survey and report back to their superiors, and did not come with medical aid of any kind.
People think that FEMA is there to hand out bottles of water, and it's not what they do. FEMA has a role to play. They have a very specific role. They bring in ships, they bring in airplanes, they bring in tractor trailers with pallets of things. But they're a big machine, and there's gaps in that thing. And you're seeing one of the gaps here, and we help fill that role. These guys are in a bad situation before, and now they're struggling for real basic things. One of the risks that you run is people going from fear to hopelessness. Those are the folks that we're trying to reach.
And how are they reached? How are they even found?
Word of mouth, mostly.
And what's your role in all this?
Ghost in the machine. I'm lucky enough to be able to communicate with folks in FEMA, the state of Puerto Rico.
For a ghost, Robert makes his presence well known. Not only was he the de facto leader of the mission, now with FEMA in tow, he created his own maps to survey storm damage.
So we're right here.
And delivered them to FEMA HQ free of charge.
I have pretty good reach.
Perhaps that's how he managed to earn himself a coveted FEMA badge without actually working for them. And it's these relationships that allow him to operate more efficiently than an NGO or a government agency.
We're able to resolve problems at a different level.
next stop was on a mountaintop, a family of 11 struggling to care for their special needs brother in what was left of their house.
Probably we are the first health team to come and visit this family.
Muy bien, todo muy bien.
The patient has Down syndrome. He is all day in bed. The difficulty with this is the patient cannot be alone. The most important thing is that you need to take care of the chronic disease besides disability, because they have been not going to a doctor, and no doctor has come in here yet.
So we need a refill of this medication.
After maybe 54 days, it's not getting better. And the only way that you can be able to see that is coming to the ground, drive, and see the people and talk to the people.
You can see San Juan from here, but you can't get there. It's like the Emerald City.
On this stop, we caught word that a man living alone at the edge of the jungle was in need of care.
So we decided to take a little detour, come up here and check out and see what's going on. One of the challenges is to find those people that are at the end of these roads that need help.
¿Pero por qué estás solo? ¿Por qué estás por acá tan solo? I'm asking about why he's alone right here. He said things of life happens. Yeah, I'm here by myself. So ¿dónde vive acá? En la parte de... This is not a job. To do this, you need to have passion for what you can do. You're not going to get paid.
It's said in disaster response and emergency response that the real first responders are your neighbors. You don't need to wait for a lucrative FEMA contract to go out and do good and to help the community.
In the end, do you feel like you're making a difference?
Lives you touch and people that you can affect. I don't really think about it in those terms.
But why do you do it?
It helps me sleep at night. I think it's as much for the people that are going out to help and do things as it is for the people that you affect.
Whether out of altruism, or the lure of a paid gig, or some mixture of the two, Anderson hopes to stay here to help shape Puerto Rico's future.
Puerto Rico's essentially been a colony for 400 years. It was treated poorly by the Spanish. It was not treated well by the United States when they first got here. Puerto Rico can continue in the way that it's always been, or Puerto Rico can rebuild itself like nothing that's ever been. And we have to do everything we can to make that real. That's the bottom line.
When I met him first online, I found him to be really sweet. I think I was the one who was talking for an hour. He was just listening.
When we met, I saw her. She was beautiful, intelligent, and kind, which was, something that I was looking for.
Anshu and Sumit are one of about 12 million couples that get married in India every year. Unlike their parents' generation, they're not from two close villages, but from two cities on opposite sides of the country. And their love didn't start through community matchmaking, marriage brokers, or classified ads in newspapers, but began online.
So we met through jeevansati.com. So it's basically an online portal where we have detailed profile of different grooms and brides.
It makes a lot of remote profiles who are located in distant areas more accessible.
Thanks to growing internet and smartphone usage, matrimony websites and apps in India are starting to disrupt the matchmaking industry. More and more people are finding their partners at the click of a mouse. jeevansati.com, where Anshu and Sumit met, is one of the biggest players. Young Indians looking for love set up profiles including their caste and horoscope, but their criteria for choosing spouses appears to be changing.
We have seen the shift from, traditional caste community conservative parameters to something like which is more focused on education, employment.
Anshu and Sumit's marriage was initiated by their parents, but modern Indian couples like them have more input than previous generations.
We looked up to them to agree for the proposal, but it was primarily our decision that we wanted to be with each other.
So what's the emoji like you use the most to send to each other?
There's a bear which basically we use for indicating a hug.
Yeah, that's our language basically. Bear icon for a hug.
Time flies when you're in love, and just 1.5 months after they first met online, the couple got engaged. They decided to hold their wedding less than 3 months later. But planning a traditional Hindu wedding on such short notice is no easy task. The massive event usually lasts 3 days, has various ceremonies and celebrations, and involves the entire two families and hundreds of guests. Luckily, there are websites and apps for that.
We searched online, we got in touch with Wedding Brigade, and they helped us finalize the venue. And it makes the search faster and efficient.
Startups like the Wedding Brigade are challenging traditional wedding planners in this $50 billion industry. It provides various services from booking banquet venues to buying wedding gowns. The website makes money by charging commission from vendors.
People don't want to be limited to what is available around them. They want to know the entire range of options available before making a decision. And now it's easy to find almost everything on one portal.
Anshu and Sumit are officially married in a ritual that has gone on for thousands of years, but their love started in a very new way. Technologies might be changing the way couples meet, date, and get married in India, but they're definitely not changing everything.
The technology was only the first level help that we could get to find each other. Everything else was like very humanly and emotions and feelings based.
Massachusetts Senator Elizabeth Warren has become a symbol of everything the Republican Party stands against.
Everyone gets a right to basic health care. We need strong oversight of these banks.
A legal scholar and a consumer advocate turned politician, Warren has branded herself as a champion of the working class and made a career out of standing up to big business. While rumors of a 2020 presidency bid remain just that,
I'm not running for president.
her Senate seat is up for re-election in 2018, and Republicans are already pumping millions into super PACs to defeat her. This is the story of how a law professor and politician came to be seen as the biggest threat to Republican values and the greatest hope for progressive America. Elizabeth Warren was born Elizabeth Ann Herron, the youngest of 3 siblings, on June 22, 1949, in Oklahoma City to middle-class parents. After waiting tables to help her family pay the bills, Warren became a star on the high school debate team. She landed a scholarship to George Washington University at the age of 16, but 2 years later dropped out to marry her high school sweetheart, Jim Warren. By 1980, Warren was a mother of 2, divorced and remarried, had earned a bachelor's degree from the University of Houston, a juris degree from Rutgers, and practicing law in New Jersey. Warren then went on to become an influential law professor, teaching, lecturing, and publishing highly cited work on bankruptcy and commercial law at 7 universities around the country, eventually settling at Harvard Law School. But Warren wasn't always a liberal lion.
Elizabeth Warren used to be a Republican, actually.
That's Stephen Dennis.
I'm a Senate reporter for Bloomberg. Around the time that Elizabeth Warren switched parties, she became a fierce opponent of a Republican drive to make it much harder to file for bankruptcy. She fought that for a decade. It ended up passing anyways.
While her efforts ultimately failed, her warning calls were heard in 2008.
We're in the midst of a serious financial crisis. Our entire economy is in danger, and without immediate action by Congress, America could slip into a financial panic, and a distressing scenario would unfold.
Professor Warren was tapped to help with oversight in the government bailout.
She would excoriate bankers and their bonuses and their practices.
Why should the U.S. taxpayer alone carry Citi?
She proposed a series of tough regulations, which became the basis for much of the Dodd-Frank financial law that we have today. That sort of catapulted her to national stardom, particularly among the progressive left.
Encouraged by her newfound notoriety, Warren declared her bid for the U.S. Senate on September 14, 2011. During the race, her opponent Scott Brown tried to derail Warren by accusing her of falsely claiming Native American heritage, a controversy that earned her the nickname Pocahontas. Nevertheless, she was victorious and won the Senate seat by a comfortable margin. She used her new tenure to challenge everyone, from banking regulators and Treasury officials to members of Wall Street and Congress.
I'm really concerned that too big to fail has become too big for trial. We need tough new laws to hold corporate executives personally accountable. No one should be above the law.
She called for Wells Fargo CEO John Stump to resign for fraud, introduced the Bank on Student Loans Fairness Act, and reintroduced the 21st Century Glass-Steagall Act. In 2016, after staying silent during the Democratic primary battle, Warren finally endorsed Hillary Clinton and had some harsh words for candidate Trump.
Donald Trump is a loud, nasty, thin-skinned fraud who has never risked anything for anyone, and that is just one of the many reasons he will never be president of the United States.
But she was wrong.
The forgotten men and women of our country will be forgotten no longer.
Warren wasted no time resisting Trump's agenda.
Have you ever managed or overseen a $1 trillion loan program?
I have not.
How about a $1 billion loan program?
I have not.
In the Donald Trump era, Elizabeth Warren has been playing defense and trying to